market is strong because the economy is strong overall.
Ultimately, what's going to drive this market higher is going to be the AI trade.
I think that the entire market is one trade, and I think right now we're in the boom part of the trade.
Certainly tech or AI has soaked up all the oxygen in the room here.
We're forgetting that there's a lot of other industries.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, facing down a triple threat. Tech stocks looking to bounce following the worst day of losses this year as another round of strikes between Iran and Israel is sending crude higher. Rates are staying elevated. Heading into the latest read on inflation, investors pricing in a hike.
They're pricing in a hike because, Jonathan, we had a very strong jobs report on Friday. At the same time, we have elevated inflation. Potentially, we're going to see even more of that as the conflict in Iran continues. Now, you even have Goldman over the weekend saying they do not expect a cut. A lot of banks are going to have to shift how they think about this market. Interesting, though, I was with the president over the weekend. He still is pushing for a rate decrease when it comes to the Federal Reserve.
The president's pushing back. The market's pricing it in. Goldman's dropping its call for rate cuts this year. BNP Paribas making a call for a rate hike starting later this year. We'll spend some time on that. We'll spend some time on this. Crude bouncing back. WTI and Brent. Brent crude this morning edging higher by 4%, $97 a barrel. Iran striking Israel. The president saying don't strike back. Israel striking back.
Right, the president told FT when it comes to Netanyahu that he wouldn't have a choice. I call the shots. He doesn't call the shots. This could be incredibly frustrating for this White House because now they don't really have a say in what Iran is doing, clearly, and they don't have a say right now in what's going on in terms of Israel and how they're going to react. Jonathan, we are more than 100 days into this conflict, and with Iran, they've always said that Lebanon was one of their red lines, but that's just been rhetoric. What we've seen the past 24 hours is now they've taken that rhetoric and they turned it into action.
That's unsettling the bond market as well this morning. That move in crude. Yields up across the curve. 10s this morning up by 3, 456. 2s this morning up by 2, 417 and closing in on 420. Check out equities on the S&P 500, on the Nasdaq, on the Russell. On the S&P, worst day of the year. On Friday, on the Nasdaq, the worst day since Liberation Week. For the semis, the worst day since 2020. Futures up this morning on the Nasdaq by 0.6%. Jensen Huang of Nvidia, you should be very happy because now you can buy at a discount.
So he's saying if you want to get into this market, this pullback looks right for you to join in. The problem is, Jonathan, a lot of people are going to be thinking about this sell-off. Is it because of the fact that now the market is pricing in a hike in the United States? Is this potentially just panic selling? Or did we just go too far, too quickly when it comes to the AI trade?
We have got a lot to work through this week. Inflation data later this week, and then the Federal Reserve just a week away next Wednesday. Kevin Walsh stepping up and facing down some big calls for maybe later this year hiking interest rates. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as investors come down from AI euphoria. John Lieber of Eurasia Group as Iran and Israel exchange fresh strikes. And frankly, of HSBC, as Jensen Huang suggests, buying the dip. We begin this hour with stocks looking to recover following the biggest one-day loss of the year so far. Cam Dawson of New Edge Wealth writing, after a 9-week winning streak at a breakneck pace, we should not be surprised to see some come down from the huge gains. Cam is joining us for the hour and joins us now for more. Cam, good morning. Good to see you.
Good morning.
We've been told repeatedly the fundamentals are great, but the technicals are stretched. So the technicals beginning to bite.
Yeah. Beta bites both ways. We had been enjoying a massive beta rally where we got to some pretty big extremes come midweek last week. 76% above the 200-day moving average on the SOX. You got the Kospi up to 112% above its 200-day moving average. That would qualify as a classic price bubble. And so we're seeing this unwind just out of these really big overbought conditions. And what's notable is that we're nowhere near oversold. Just to get to your 50-day moving average on the SOX, you would be down another 13%. And yes, the fundamentals are great, but you had seen these stocks get so overbought, move so far so fast. It was sort of like seeing Icarus fly closer and closer to the sun and getting a little bit of that wax melting.
Do you think then at this point there is an air pocket then for further declines from here?
Yeah, look, I think it would be actually a very healthy thing to see. I think the other thing that's really notable to focus on is the fact that you had seen valuations already reset back up to their 2026 highs. So the whole dynamic that had happened at the start of the year is that valuations derated significantly to about 17 times on the stocks just because earnings estimates went up so much. Now we've effectively reclosed that gap where we've seen valuations get back up to 28 times forward. So arguably you could say that the easy part is over, meaning the valuation reset is over. And now the question is, do you still see earnings upside for these semiconductors from here?
Is the next catalyst potentially the inflation data, as Jonathan mentioned, later in the week?
Well, it was certainly for the broad markets. And it'll be fascinating because we could print a 4 handle on headline CPI. We could also print a 6 handle on headline PPI. And certainly if we're looking at the bond market, that would put upward pressure on yields. And you're already pricing in 117% chance of a hike by the end of the year for the Fed, which just suggests that could we even see more upside on that if you get a hot CPI or PPI print?
A 4 handle on this inflation would basically mean what for Kevin Warsh?
Yeah, it means his back is very firmly in a corner, and he has very few ways to argue that the Fed should be cutting rates at this point. Whether you're looking at the labor market, which remains very resilient, or you're looking at the inflation picture. And I think the other important part about the inflation picture is that you're seeing this upward pressure on core CPI as well. So yes, wages remain very subdued, and I think that's a really important point about this employment picture. You're not seeing upward pressure on wages, but you're still seeing things like that super core CPI, core services ex housing move higher, which just suggests that this can't be something that you completely look through.
Lisa has talked about this, and we'll catch up with Lisa a little bit later this morning. She's found herself in Rio, in Brazil, believe it or not. We'll spend some time on that in a few hours' time. Lisa's talked about the fact that inflation is close to 4, unemployment is close to 4, and here we are having a discussion about dropping an easing bus.
Yeah.
Not hiking rates, but dropping an easing bus. Can you expect anything more than just that at next week's meeting?
Well, I would add one other peculiar factor, which is that if you look at five-year inflation spreads or inflation break-evens, they remain very contained. So you have a Fed that's not necessarily saying that we're going to fight inflation with a lot of gusto, and yet the bond market says, yeah, but we think you're going to be successful at getting back to 2%. So I think the question will be is as we move through later in the year, if inflation still continues to trend higher, if energy prices continue to push higher, will we start to see the long end of the curve start to become a little bit more dubious of the Fed's willingness to fight inflation? And if that's the case, that really is the thing that forces the Fed's hand to start coming out and talking a much tougher game than just saying, oh, we're not easing.
So 2s out to 10s, we've seen some flattening. Would you expect some steepening to come back into the curve?
I think that's certainly possible this week, mostly if we continue to see resilient economic data. The relationship to watch is the fact that you're seeing economic surprises continue to push higher. That's putting a lot more upward pressure on the back end of the curve. But you've seen a lot more upside on the front end of the curve, which is why you're seeing that flattening. So if you see the hotter inflation data and if you see things like the NFIB survey, which we also get this week, show some improvement, that could be another reason why we see that back end back up.
This week is not just about the data, it's also about supply, IPOs. SpaceX very much on the horizon. We've seen an upsize capital raise from Alphabet. The FT reporting on Friday that Meta's considering doing something similar. That contributed to this move. Corporate America is telling you it's a good time to sell equity. Why is it a good time for investors to buy it?
Yeah, well, they're telling you it's a good time that they need more money in order to fund this AI capex. And this whole bull market is built on the idea that the Mag 7 would take their incredible, formerly very strong balance sheets and use them to fund this massive capex spending. And the question is, how do we get to that next leg higher? We've already gone from expecting 10% growth in AI revenue or AI capex spending this time last year to up to 80% growth for this year. People are expecting that now to go from 1 trillion up to 1.2 trillion. To fund that gap, you need more capital. And what this could be a sign is that maybe we're running a little bit long and thinking that maybe we can't turn to debt markets as much. And so it certainly suggests that in order for this to keep running, you have to have a continued bull market, which just means that there's so much pressure for the AI capex to continue to deliver.
We spoke about this last time you were on. Where are people taking capital from to then make sure they can get in on these IPOs?
I mean, it certainly seems to be in areas of other risk assets. People have been thinking maybe that's where some of the selling pressure is coming from, things like Bitcoin, in order to make room for it. But we still come back to the point that there are a lot of investors that don't have a choice in order to make room for some of these names and these IPOs, simply because they're being forced into indices at a much more rapid pace. I think the turn last week, though, from S&P 500, S&P Global, of effectively saying that they are not going to relax their profitability rule, was a very important potential sentiment shift in how quickly these things could be included in that big index. But I think at the end of the day, that's a really good thing for index investors when we think about long-term quality.
Let's bring up Bitcoin. Cam, you mentioned Bitcoin. Bitcoin took out the lows of the year in Friday's session, down 50% from the start of October. We caught up with Lisa Shallard of Morgan Stanley recently. You asked the question about whether we're seeing signs of things tightening up a little bit. Bitcoin is a liquidity-oriented asset. When financial conditions are beginning to tighten, it falls back. Over the next 12 to 18 months, Lisa's words, as everyone is issuing debt, as everyone is issuing stock, we're going to start to see things tighten up here. Would you expect to see further signs of that in the year ahead?
Yeah, I think the most interesting thing over the course of the last, let's call it 9 months, is that Bitcoin has completely sat out on this risk rally. So if we think about the cohort of things that typically go together in liquidity sensitive areas, it's the least profitable companies, it's the most speculative parts of the market, and Bitcoin. But you've seen Bitcoin sit out on the speculative rally, but you have things like a 60% rally in unprofitable tech over the course of the last 2 months. So the question would be, is Bitcoin effectively a harbinger of things to come for those other speculative parts of the market? And certainly we're starting to see that unwind on Friday as we saw a lot of that beta and momentum come out of the market.
Cam, going to stick with us, I'm happy to say, through the air. Cameron Dawson there of New Edge Wealth. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Thank you. President Donald Trump demanding that Iran and Israel stop shooting immediately. Trump reiterating his demand in a Truth Social this morning after the two countries exchanged missile strikes overnight. It's one of the most serious tests of the ceasefire that took effect 2 months ago. Nvidia and SK Hynix are collaborating on designing future generations of memory chips for AI. The announcement comes as Nvidia CEO Jensen Huang visits Seoul for meetings with his company's Korean partners. If you want to go to Game 3 of the NBA Finals tonight, it's going to cost you. The average price for a ticket, about $8,000. Annmarie asked President Trump what he thought of the sky-high prices.
Well, I know, but they can watch it on television. It's sort of semi-free to watch it on television, but that's the way life goes.
Trump will be at Madison Square Garden tonight for tonight's game. Watch parties outside the garden have been cancelled for security reasons. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. Watch parties are cancelled outside MSG. You've got to arrive 2 hours early if you can afford the tickets. I wonder what kind of reception the president might get a little bit later this evening.
You can't bring your bags in after you maybe spent $8, $10, or if you're maybe a little crazy, $250,000 on a ticket to go watch the Knicks play. I don't know. I think it's going to be a mixed reception. I've been to the Yankee game with the president, and it was a mixed reception. I think this could potentially be a bit similar.
Looking forward to the game a little bit later this evening. Up next on the programme, we'll catch up with the latest in the Middle East, the president's red line.
We have the ultimate blockade. I don't consider that a war. My red line would be if I think I wasn't going to make a deal or if I wasn't going to make a deal fast enough.
John Lieber of Eurasia Group joins us next, live from New York City this morning. Good morning. Coming up this week, absolutely stacked with economic data and a big event coming up later this week. CPI dropping on Wednesday. Look out for that. The final read on inflation going into the Fed's next meeting. The Fed's next meeting, Chair Walsh's first meeting. On Thursday, we should price an IPO that's basically already priced. Heading into Friday, where SpaceX is set to begin trading. A week ago, we'd say, what a time for an IPO. Stocks are buoyant, record highs, 9-week winner streak, up 20% from the lows. What a difference a day makes. Friday's sell-off, and all of a sudden we start to think about maybe the window's closing for these mega IPOs.
As we just heard from Cameron, potentially, what does it mean if we get very hot inflation before the SpaceX IPO? Does that also put another pressure point on financial markets because people are going to have to price in, wow, maybe the Fed really does need to hike rates if we have officially a 4 handle on inflation.
Futures bouncing back this morning, up a third on the S&P 500. Friday, pretty dreadful for tech names. The semis have absolutely ripped off the lows of March. They fell back down to earth, down about 10% in a single session. This morning on the Nasdaq, up by 0.7. Annmarie mentioned the tension in the bond market. Let's talk about it. 10s with the first close above 450 in about 2 weeks. 456 this morning, and up another 3 basis points. New high for the year on a 2-year, 417. And much of the move more recently had nothing to do with energy. Now this morning it does. Crude, Brent, WTI pushing higher by 4%. Brent crude 96.85. Under surveillance this morning, the president's red line.
We have the ultimate blockade. I don't consider that a war. My red line would be if I think I wasn't going to make a deal or if I wasn't going to make a deal fast enough. So we're having very good negotiations with the people that are leading the country now. We'll either have something done fairly quickly or we'll finish it out militarily.
So here's the latest this morning. Israel retaliating against Iranian missile strikes, defying President Trump's request for restraint. The president telling the Financial Times that Israel will have to accept any deal between Washington and Tehran because he, quote, calls all the shots. Bloomberg's Tyler Kendall joins us now for more. Tyler, did the president call the shots over the weekend?
Well, John, at this point, it doesn't appear that he was able to keep a lid on the fighting, as this White House and President Trump have directly said that they do not want to see this renewed escalation because it could risk a diplomatic deal. In fact, Axios had reported that President Trump asked Israeli Prime Minister Benjamin Netanyahu directly to hold off on retaliation in a bid to give diplomacy more time. And, of course, as the White House faces domestic pressure to get an end to this conflict. But that didn't happen. And the president also went on in that NBC News interview to say that he wants Israel to be, quote, more surgical in its response to the Iranian-backed militant group Hezbollah, because, as you well know, Iran has long maintained at this point that a ceasefire in Lebanon needs to be rolled into any broader U.S.-Iran deal, though both sides have said that that operation against the militant group is a separate front. But at this point, it's becoming a huge sticking point in these ongoing negotiations, though we should say that Israel and Lebanon did reach an extended ceasefire agreement just last week, though Hezbollah rejected the terms. But at this point, it's really putting this focus point on how Iran's support of proxy militia groups, not just Hezbollah, but now also the Iranian-backed Houthis in Yemen, could risk derailing a deal. John, new this morning, we got a statement out of this militia group saying that they are going to declare a ban on all Israeli ships in the Red Sea. The statement didn't go so far as to say that this would extend to all commercial shipping, though it does risk derailing this key bypass route when it comes to the Strait of Hormuz, just further complicating these ongoing negotiations.
Tyler Kendall down in Washington, D.C. Tyler, thank you. We'll catch up with Tyler in the next hour. To build on the conversation, John Lieber of Eurasia Group joins us now for more. John, welcome to the programme. The president looks committed to de-escalation. Israel and Iran do not. Where does that leave the president's position?
He's in a tough spot for sure. And, you know, like you said, he told Netanyahu not to fire, and he did. Prime Minister Netanyahu's under quite a bit of pressure domestically in order to show that he's not Trump's puppet and that he can continue to stand up to the Iranians, which is going to make him more and more difficult to control as Trump is asking for de-escalation. Now, I think that the two relevant things that happened this morning were, one, the Iranians threatening regional energy infrastructure, which suggests a complete collapse of the ceasefire if that happens, because it would bring the other Gulf partners back into the battle. And then two is the fact that the Houthis are now in this war in a way they haven't been in the past. They've largely sat this out. They're now saying they're going to target Israeli ships through the region. As Tyler said, that doesn't mean they're targeting all ships, but the fact is that they're now, the war is, I think, on the verge of threatening to expand, and Trump has to scramble hard in order to keep that from happening. And it's unclear if he has the ability to sway Netanyahu or have any sway in Iran either.
Do you think the United States has to come in at this point? Do you think this is a red line for them in terms of the ceasefire?
Come in militarily? No,
yes.
I don't think so. I think that I think the U.S. wants to stay out of this. The U.S. is positioned to continue this fight. They've got still assets in the region, and we think it's possible that this ceasefire collapses altogether and the U.S. and Iran go back to fighting. But with exchange of missiles between just Israel and Iran, if it stays that way, I think the U.S. can stay out of it. It becomes more problematic if the Iranians start targeting Gulf energy infrastructure. And in their statement this morning, what they said was that any attacks that happen are ultimately the responsibility of the United States. So they know that the channel to bring the U.S. back into this is through those energy infrastructure attacks. But in the meantime, if this just remains between Israel and Iran, I think that's sustainable for the U.S., at least for a short period of time.
Well, Iran warned that the U.S. is the one that bears responsibility for Israel's actions. So where does this leave the talks right now? Have they just completely collapsed?
No, I don't think they've completely collapsed. I think we have to see what happens if the missiles stop flying today or not. I would expect that they do. Trump is very incentivized to get a deal. What we've been hearing over the weekend was that a deal is ever closer. Now, of course, we've been hearing that for weeks, and there's been very incremental progress made on this deal coming together. But I do think that they are getting closer, and ultimately that's what President Trump wants, because a return to the U.S. engaging in the war is essentially driving into a box canyon they can't really get out of, given the Iranian missile capacity.
How serious is this complete and total ban on Israeli shipping in the Red Sea, given that this has been such an important offset for Saudi Arabia's shipping of oil? Is this something that we could see cascade into even higher prices?
It could. The fact that they're only talking about Israeli shipping right now and not all shipping, so the Saudis still seem to have a free pass, I think is a positive sign. The Houthis have been staying out of this, we think, largely at the behest of some of the Saudis and others in the region. That probably continues. And the fact that this escalation is so relatively measured, I think means that this isn't a tipping point into threatening the rest of the shipping lane yet. But of course, shipping is still significantly down from where it was, pre-October 7th.
Let's deal with that word yet. Cam's taken us on to the right question, I think. Annmarie mentioned at the moment she walked into the studio this morning, the Red Sea and the Houthis. John, what is stopping them? What does Saudi Arabia have over them right now? Because there's no love lost between those two.
I think it might just be bags of cash. I mean, I think that the Saudis have been very aggressive about keeping the Saudis on their side and keeping them out of this. And the Houthis are weakened, just like every other Iranian proxy group. Iran has not had the ability to support Hezbollah the way they used to, and they don't have the ability to support the Houthis either. And I think that gives the Saudis an opportunity to pay them off essentially and say, don't come into this. This is not your war, and we can help you if you need it. And I think that's what's going on.
But they are taking baby steps in declaring a total ban of Israeli maritime navigation. If we were to see the Bab el-Mandeb Strait become closed, John, what kind of response could we see from this White House? Because that would be the second choke point closed in the Gulf.
Yeah, great question. I think that ultimately they blame this on the Iranians. If that happens, that could be the thing that brings the U.S. back into the conflict because of its effect on the Gulf shippers, who are the ones who are asking the U.S. to stay out of this and asking for de-escalation right now. But that would put us in a totally different trajectory. And again, we're not there yet. So, I think that it is a meaningful sign that the Houthis are now reacting to the latest volley of Israeli attacks when they didn't do anything earlier. So something's changed. I'm not sure we know what yet.
John, appreciate the update. Thank you, sir. John Lieber there of Eurasia Group. The Israelis striking Lebanon, Iran supporting their proxies. Ultimately, the president turning around and saying, don't strike back, and then Israel doing just that. Getting a little messier as the days go by.
And it's even getting messier this morning. The president, 5:36 a.m., he's up. Israel and Iran must immediately stop, quote, shooting, says the president. And now you see these baby steps of the Houthis getting involved, just when it comes to Israeli maritime shipping. But the next question is, well, when does this expand beyond that?
Cam, just quickly, is this starting to become a market event again? It's kind of off to the side for a number of months. Yeah. Is it back on the center table again?
I think the price that matters for markets is the average gasoline price, and it's come down over the course of the last couple of weeks, but given this move higher in oil prices, it's likely to climb higher. We're exiting the shoulder season, going into peak driving season, and this is when it becomes a bigger political issue, potentially bigger economic data issue, and then potentially an even bigger earnings issue.
It will certainly be an inflation issue later this week. CPI dropping on Wednesday. Looking at the bond market this morning, yields are higher off the back of this move in energy. WTI at 95, Brent crude, let's round it up to 97. The chip stocks and equity futures are bouncing back. Coming up, we'll catch up with Frank Lee of HSBC as Nvidia's Jensen Huang suggests buying the dip following a 10% decline on the semis in Friday's session alone. From New York City, you're watching Bloomberg TV. Equities this morning bounced by 0.3% on the S&P 500 after snapping a 9-week winning streak. We had not seen a weekly loss since the month of March, and since then we've rallied about 20% off the lows going into Friday's big declines. Looking at the Nasdaq this morning, higher by 0.6%. Big bounce for that particular index, the worst day for that particular index since the Liberation Week mess of last April. For the semis, the worst day going back to 2020, the semis down by something like 10%. This morning, here's your bounce across several single names, Nvidia included. Nvidia this morning up by 1.7%, Broadcom up by 1.5%. In the bond market biting as well. Yields higher across the curve once again this morning, up by 2 on 2s to 417, up by 3 on 10s to 456. Jobs came in hot, much hotter than expected going into CPI later this week. Inflation dropping on Wednesday, and the rate hike bets are building. And this move's encouraging yet. Crude was actually down for a couple of sessions last week. Energy wasn't a big factor in the backup in yields. It was all about the data. This morning, though, it contributes to the move, up by 4% on Brent, 97. WTI, 94.50.
And you certainly don't want to see oil prices going up as we head into peak driving season, as Cameron was talking about. It's interesting because the AAA national average is $4.16. It's actually been coming down closer to $4, where a lot of people thought by this time we'd be at $5 a gallon across continental United States. The inflation data this week is going to be so telling and so important because already, as you mentioned, going into it, we have the market already pricing in a hike this year.
Kevin Walsh, box office next Wednesday. You've got to put out some forecasts, change the guidance on day one, your first meeting at the Federal Reserve. On our radar this morning, Israel striking back after Tehran's missile attack over the weekend. It's their first direct exchange of fire since April. The IDF saying it hit targets across the country. Iran reporting explosions in the capital. Elsewhere, Marvell shares are rallying with the chipmaker set to join the S&P 500. The company blowing past estimates in the latest earnings report. Marvell starts trading on the index later this month. And finally, the president heading to Madison Square Garden for the NBA Finals. The president telling Annmarie he's unfazed by sky-high ticket prices.
The cheapest price for the Game 3 you're going to is $8,000. Everyday Americans can't afford these sporting events.
Well, I know, but they can watch it on television. It's sort of semi-free to watch it on television, but that's the way life goes.
The president says that's the way life goes. Heading into this mess, the NYPD cancelling watch parties outside of the arena as a safety precaution, and also telling guests to get there 2 hours early before the game.
2 hours early, don't bring a bag. I think the watch parties is really going to annoy Knicks fans. They've been having parties all weekend in preparation for Monday, Game 3. They are so excited. One thing that would be helping the president is to get in now. I see a 5 handle on StubHub, so it's not the 8 that I saw on Friday.
5,000, just to be clear for people.
Yes, 5,000. Here is the issue. I understand the president's point. The Knicks are kind of idiosyncratic. They haven't been in the finals since the 90s.
Sure.
It's the one New York basketball team, kind of. I mean, the Nets, come on. But it's not just the Knicks. If you look at the average price for World Cup tickets, they're $1,000. The median take-home for an American worker a week is $1,000. Who is affording a family to go out at these sporting events? And I don't think that's the message you want in the midterm elections. That's the way life goes, tough tarts. I'm not sure that's going to land.
The optics aren't great, and I think we understand the context for a lot of this conversation. You look at where energy prices are right now. People are getting squeezed. Cam, you look at where consumer confidence is right now. Rock bottom. This has been accumulating for a long, long time. How squeezed is this consumer in America.
Yeah, we talk about tank bottoms when it comes to oil prices. I think we should be talking about tank bottoms for the consumer as well, because you're now at a point where you have real incomes turning negative because wage growth has been subdued. It's running at about 3.8% on a nominal basis. But with inflation moving higher, you're effectively at this point where consumers are continuing to lose purchasing power. Now, they've been dipping into savings, but that's only made possible by the really strong bull market. You typically see lower savings rate as household net worth goes higher. So if you continue to see volatility within equity markets, you effectively have a consumer, both the top and the bottom part of the K, that could hit a wall.
Time is not great. We got rate cuts going into the last election. We might get a conversation about rate hikes going into the midterms later this year.
And how political is the president going to feel if his own pick, Kevin Warsh, actually hikes rates at that October meeting? You know what I was thinking about, Jonathan, as you were talking about how challenging it's going to be for Kevin Warsh? More than ever now, I think he decides to not put a dot anywhere on the plot when it comes to his first meeting, because it's just too challenging.
Let's see if that's the case. That could make headlines. The latest from the president, the comments just dropping. This coming from President Trump just moments ago. Both sides, Israel and Iran, are looking to do an immediate ceasefire. Final negotiations on peace are proceeding, subject to ignorance or stupidity getting in the way. The blockade will remain in place and in full force and effect until a final deal is reached. The president saying things should move quickly. As those headlines drop, and we've got no idea what's behind them and what isn't this morning, but futures on the S&P 500 just taking another leg higher, on the S&P up by 0.4%, and commodities just coming off session highs. Brent and WTI down to 94, Brent approaching 96.
The president is trying to inject some optimism this morning. A lot of people are saying because we've seen Iran with these ballistic missiles at Israel, we saw them talk a lot about rhetoric on how Hezbollah, Lebanon needs to be included in the ceasefire, but never actually take that action. It seems like the president, with these comments, is trying to hold on to that ceasefire and tell everyone, no, he is committed to having this end. As he was talking about at this event I was with him on Friday, he said it's either going to end with a piece of paper or a much harder decision to make, which would basically be more kinetic warfare. He seems to be committed right now to ending it at the diplomatic table with a piece of paper.
Cam, you're in the market. How frustrating is this? You see a headline like that. Do you believe that's actually happening, or is that just a communication tool for financial markets?
I mean, we've always been saying it's impossible to trade a taco, and it just seems like we have this constant put under the market, whether it's coming from buying individual companies or effectively backing off from the most rhetoric when it comes to the war. So it's really hard to fight, and it's really hard to predict, which just suggests keeping that long-term perspective, as unsatisfying as that answer is.
Well, futures bounced this morning, up by 0.4% on the S&P. Tech stocks looking for a bounce also following their worst day for chip stocks since 2020. The Nvidia boss, Jensen Huang, calling the sell-off a buying opportunity.
With respect to the stock price, everybody should be very excited. They can now buy stock at a cheaper price. And it's absolutely true that the future of AI is very bright.
Frankly, of HSBC still maintaining a bullish stance with buy ratings on Nvidia, Broadcom and Intel. He joins us now for more. Frank, welcome to the programme. Are you excited following Friday's losses?
Yeah, I mean, I think it was actually, like Jensen highlighted, an opportunity for a lot of people that missed this rally, because we've seen a very strong rally since March. And I think at the end of the day, for people who've been regretting it, this is an opportunity. But, just to bear in mind, I think, every few months or so, you always see this skittishness around AI. We've seen after the last 2 or 3 years. And I think this is another example of that in terms of that skittishness, in terms of, markets run ahead of itself. And I think, there's nothing structurally or fundamentally that we see any problems. If anything, I would say, the proof of concept of AI, as in terms of being used is even stronger than ever.
Well, Frank, let's get into some of that. So I wonder how much of it is about technicals. Clearly very, very stretched, and a lot of people pointing to that. But let's talk about some of the fundamentals right now. Broadcom clearly fell short of expectations. I think that tells you something about how the story is priced, and you can give me your opinion on that in just a moment. But then for the whole complex at the moment, what we've witnessed, for many at least, is a monster wealth transfer from very rich hyperscalers to chip players. And what we've seen more recently, particularly on Friday, the likes of Meta, in the Financial Times, reportedly considering an equity capital raise and the market pushing back. Frank, to me at least, that's the market, early signs, pushing back against all this spending that the chip stocks have benefited from, Frank. Can we get into those fundamentals?
Yeah, sure. I think to your earlier point about Broadcom and the big sell-off, I think at the end of the day, the market has gotten so used to just beat and raise, not just for the quarter, but in terms of a bigger and bigger TAM in terms of the backlog. So I think one of the reasons the market was disappointed is that they had expected the Hock Tan to raise his backlog order even more significantly for next year, which he didn't, which I don't think he really did on this call. That's not to say that there's not upside going forward, but he just didn't continue to raise that bar. And I think the market had gotten so used to raising the bar on the TAM, and that's been what's driving the stock price more than natural earnings. Is just a TAM opportunity. And I think that's something that we still believe that the fundamental direction is there. And we still think that earnings will still have to go up. It's just that there's going to be a pause before these managements continue to raise that TAM again. And I think that's what we're seeing right now.
Frank, me and my colleague, Jennifer DeLuy, were talking to the president on Friday about this idea of the U.S. taking equity stakes in these AI companies. And the president said there are concepts where pieces could be given to the American public. What do you make of this?
Yeah, I mean, it's certainly very unusual because that means that, you have government interest in this. If you look at, what so far one of their early examples is the direct stake they have in Intel. It looks to be a brilliant move in retrospect, given how much the stock has gone up. But it does feed on momentum, right? Since the investment by the U.S. government in Intel, you continue to see a lot more positive news on Intel's businesses and clients more willing to engage. And of course, they've run into this fortuitous opportunity where agentic AI and CPU demand has created shortages. But it does, I think, give the market some confidence that they'll continue to see long-term strength and opportunities because of government backing.
Frank, so much of the upside in the earnings for semiconductors this year has been driven by the margin expansion, specifically gross margin expansion at the memory players. You have Micron now at an 80% gross margin. That's historically high, but also historically mean reverting. How cyclical are these margins now?
Yeah, so this is probably one of the biggest debates, especially among tech analysts, is the memory sector moving away from that cyclicality and becoming more of a structural story? If you look at memory in the last couple of decades, every time the memory prices hit a certain point, demand basically self-corrects because of elasticity. But that's because historically, a lot of the memory has been used in consumer products, your smartphones and PCs. This cycle is somewhat different because, even though we've seen significant increases in memory, it's not a consumer-driven cycle. It's been basically driven by infrastructure, CapEx. And so that seems to have a much higher tolerance than on the consumer side.
Frank Lee of HSBC. Frank, appreciate the time. I know it's late into your evening over in Asia. Thank you, sir. Appreciate it. Cam, you asked the question, I think.
Yeah.
How cyclical are some of these stories?
Yeah, I think that they do remain very cyclical names, but we happen to be in the mother of all super cycles, which is allowing them to remain at very high profitability for longer. I think I was looking at the Russell 1000 value. Guess what the largest weight in it now is? Micron. So we've now all become very exposed to all just one trade, and there really is nowhere to hide from it.
I mentioned the pushback to the likes of Meta, the big spenders that the chip stocks have benefited from. Do you think that's the start of something bigger?
Well, what we've seen is this huge divergence between the earnings growth and the free cash flow generation. If you look at names like a Meta, over the last 2 years, you've seen earnings growth between 50, 70%, but free cash flow generation down 80%, 90%, the likes of Amazon 100%. This is why they're having to tap debt markets. This is why they're having to tap equity markets. And the question is that sustainable? Will investors continue to look and say that's a good use of your capital? Maybe one place to watch is we see with SpaceX that they're leasing out their data centers to Anthropic, and they're leasing them in a way that they could get an 18-month payback. But the question is, are these companies now just turning into mega huge data center kind of REITs, and what valuation should we put on those names?
Nasdaq futures this morning bouncing back by 0.75%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Chinese President Xi Jinping is heading to North Korea today. It's his first trip there in 7 years. Analysts say he wants to reassert Beijing's influence over Kim Jong-un as the North Korean leader rapidly expands his nuclear arsenal and deepens his alliance with Russia. Shares of Monte Paschi are surging after Intesa offered to buy the bank for $35 billion. A takeover would create one of Europe's most valuable banks and boost Intesa as a leader in the Italian market. Intessa's offer comes a day after Banco BPM pitched a merger of equals with Monte Paschi. United Airlines CEO Scott Kirby says U.S. demand and capacity still strong. He spoke to Lisa at the IATA conference in Rio de Janeiro.
Time will tell. It depends on what's happening with the economy, what happens with oil prices. But I feel pretty good about where we are right now. We feel pretty good about where the demand environment is, and the consumer's been resilient, even with fares, up.
Kirby also said affluent travelers continue to spend on air travel despite a sharp increase in fares. Coming up at 7:30 Eastern, Lisa will be speaking to the COO of Southwest Airlines. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for the update. Who came up with that one? Airline conference. Where should we go? Rio. Let's make that happen.
It's pretty nice, no?
Bramo gets to go to Rio.
And so does Guy Johnson. I saw him earlier, waking
Both
up
of them are
very
there.
early to do a bit into his programming in Europe. Yeah, it's pretty good. It's a good gig.
It's a good gig. Bramo's sending me tourist shots over the weekend. Good for Bramo. Not jealous at all. Up next on the programme, call in for rate cuts.
There's no reason to raise interest rates. I would like to see rates get lower because we could build this into the greatest machine that the world has ever seen.
The president calling for cuts, the market pricing in hikes. Colin Martin of Schwab joins us next. Stocks this morning bouncing back by a third of 1% on the S&P, on the Nasdaq up by 0.7, on the Russell up by 0.8. In the bond market, 2s, 10s, 30s, yields pushing higher again following Friday's sell-off. Yields off the session highs because we're seeing this move unwind just a bit on crude, on WTI and Brent. Had a bounce this morning, taking some of that bounce back. We're up by 3.6% now on Brent, up by more than 4 moments ago. After these comments from the president out on social media, the following post, both sides, Israel and Iran, are looking to do an immediate ceasefire. Now, we haven't heard from either Israel or Iran on that particular issue, but we're hearing it from the president.
Haven't heard from either of these individuals in terms of if they will stop what the president called quote-unquote shooting. We did see ballistic missiles from Iran go over to Israel, something we have not seen. They've talked about how this is in response what Israel did when it comes to Lebanon and Hezbollah. The president is, what I feel, hanging on, desperately hanging on to the idea of this ceasefire and wants this to end at the negotiating table with a piece of paper.
Energy up, yields up, a market pricing in rate hikes under surveillance this morning. The president calling for rate cuts.
Nowadays, when you have good reports, the market goes down because they think they're going to raise interest rates. There's no reason to raise interest rates. I would like to see rates get lower because we could build this into the greatest machine that the world has ever seen. But you can't do that when everybody immediately raises interest rates.
So here's the latest this morning. The president pushing back on rate hike bets, with traders pricing in a quarter-point hike by the end of the year. Colin Martin of Schwab writing inflation remains sticky. Our base case is that the Fed remains on an extended pause. Colin joins us now for more. Colin, good morning.
Morning.
How high is that bar for rate hikes of this Federal Reserve?
It's getting lower. We've been saying it's a pretty high bar for the past handful of months now. With last Friday's labor market report, the bar keeps coming down. But we're acknowledging that things are moving very fast. There's a lot of uncertainty right now. If we look at it strictly in a vacuum, the case can be made for a hike right now. We have inflation that's been high for 5 years and counting and moving in the wrong direction, and a labor market that, at least for the time being, has shifted maybe from stabilizing to strengthening. That's the good news. But the outlook is very uncertain. I mean, you were just talking about the potential de-escalation in the Middle East. That's a major wild card. We have Warsh coming in. How open to rate hikes will he be? So rather than bouncing around too much, we're focusing on an extended pause right now. We're acknowledging that the probability or likelihood of a hike has risen, but we want to see how the next few months play out.
Well, before you get a hike, you need a hawkish bias. And we don't have one of those. We have an easing bias. And next Wednesday, at his first meeting, we're expecting him to slip into neutral. Not a hawkish bias, but neutral. Some people might be pushing back against that. Do you think there will be some on the committee next Wednesday that will push for a so-called hawkish bias?
Maybe, but there's been a lot of comments we've heard from officials over the past few weeks, and Beth Hammack last week, I think, had some neutral comments where she said right now things are okay, but maybe we'll have to, shift. I'm probably butchering her actual quote, but the idea that the direction is moving to hikes, but we don't need to do anything right now. She's been one of the more vocal hawks. She was the one who dissented the last meeting. So I think that's a nice, reasonable approach. But if we continue to see the conflict go on, which is inflationary, and if we see this labor market strength continue, I think that shift to neutral could become a shift to hawkish, but I wouldn't expect that next week.
Well, do you think anyone next week is going to say we should have a hike at that meeting?
I don't think so. But I think there will be some that are clearly moving in that direction. But given the idea that if we shift the easing bias, knowing that that was what a bunch of the dissenters were focusing on last time, and they at least shift to neutral, acknowledge that there's two-sided risks, including those hawkish risks, I don't know if we'll necessarily see a dissent.
I'm not trying to be cute. Does Kevin Warsh decide not to put a dot on the plot?
He might. I mean, he's been pretty clear about his views about the dot plot. I mean, even Powell himself, I was about to say Fed Chair Powell, former Fed Chair Powell.
Now Governor Powell.
It's been so ingrained in what we say.
I've seen a few people make that mistake in notes by accident.
So Governor Powell, at his last press conference, acknowledged that this is a discussion that committee members have had. So I think there are some, including Warsh, that maybe aren't too happy with how that goes. They acknowledge the uncertainty, and he said they just haven't come up with a better resolution. So it's possible he doesn't throw that out there because he knows, or he's been pretty clear about the downsides to that dot plot.
We now have a 2-year yield that's 40 basis points above the Fed funds rate. We always think of George Soros saying the bond market never lies. What would have to happen with the economic data to make that 2-year yield not lie?
Sure, not lie. Well, let's see. We'd need, I think, a de-escalation in the Middle East. I think we'd need to see the hit to oil prices start to show up in the data. Right now, it's not happening. We talk about the savings rate coming down. We talk about and the potential hit to higher gas prices. We're not seeing it right now. I think for a hike to happen, we need to see inflation to continue the recent trend. We used to, if you asked me 2 months ago, I'd say reaccelerate. Right now, probably just continue the trend, and the labor markets continue to strengthen. We're getting a little bit closer to that right now. But I don't think we're at a full-fledged hiking cycle. I think we're looking at 1 or 2, and we're seeing where that 2-year Treasury yield is right now. I think it is getting a little ahead of itself. But I do think a lot of it plays out with the Middle East. It sounds like it's a cop-out, but I think that does matter in terms of how high do oil prices stay and for how long, and is there a hit to consumer spending? So far, not so much, because AI and CapEx have been a key driver. But I think we're going to have to see how that plays out, especially into the summer season.
Let's just build on Cam's line of questioning. So we're talking about the difference between the policy rate and twos. Twos have come up, that's steepened. The interesting piece of this, you look further out, twos out to tens, that piece of the curve, flattening.
Yeah.
What do you think that speaks to?
I actually am a little bit confused about that because we don't expect a full hiking cycle coming up anytime soon. So I think short-term yields have probably gotten a little bit ahead of themselves. We do see more upside risk with long-term yields. So I wouldn't be surprised for a steeper curve right now, given inflation, given uncertainty. The term premium is something that we're looking at a lot right now. Inflation's not just high, it's uncertain. With Warsh as the Fed chair, use of the balance sheet is probably behind us. So I'm actually surprised that the 10-year has actually been somewhat well behaved, and I would expect a steeper yield
So you
curve.
don't want 10s here, you don't like them at 4.55?
Not yet. We're not saying now is the time to be adding duration.
Colin, it's good to see you. Thank you, sir. Colin Martin there at Schwab. Can we get the final word? Where are you on the bond market further out along the curve?
We've just been thinking that the 10-year would be stuck in a range where if you got to the high end of the range, you should be a buyer of duration as a hedge against weaker growth. And if you got to the low end of the range, you should either sell or sit on your hands.
What'd you do this morning?
Well, we were nibbling at duration as yields backed up higher back a couple of weeks ago. And so certainly if you do continue to see yields press higher, we think it is a good hedge against weaker growth. Most as we go into the summer, where the last 2 summers we've had weaker growth, weaker economic surprises, and big bond rallies.
And then cut rates 3 times into year end. As simple as that. 4.55 this morning, yields up by 2 basis points. Cam, always good to see you. Thanks for this morning. Thank you. Cameron Dawson there of New Edge Wealth. Coming up next, we'll catch up with Chris Harvey of CIBC, the former US Defense Secretary Mark Esper, Southwest Airlines COO Andrew Watterson, with Bramo in Brazil of all places, plus Erica Najarian of UBS. The second hour of Bloomberg Surveillance just around the corner.
labor market is continuing to hum along quite well.
Job growth in what fuels our economy is always a good thing.
The rates market sort of sniffing out, is monetary policy actually accommodative?
I think ultimately the next move will be a cut or two.
We're right on the precipice of pricing in a full hike.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures bouncing back from the biggest one-day loss of the year so far. The S&P up 1/3 on the Nasdaq, up by 0.7, the first weekly loss on the S&P 500 since the month of March. What a run. In the bond market, yields higher across the curve. 2s up by a single basis point, 10s up by 2 to 455 and 416 respectively, driven this morning by a bounce in energy. On Brent, on WTI, crude looks like this morning, up by 3%, 96 on Brent, 93 on WTI, call it 94 heading into inflation data a little bit later this week.
Because we've seen fresh attacks from Israel and Iran at each other, and the Houthis as well, coming in and saying they are going to get involved, at least when it comes to maritime shipping, when it comes to Israeli vessels. The president clearly is trying his best to hang on to the ceasefire, at least rhetorically, in Truth Social this morning, saying both sides are looking to do an immediate ceasefire. He keeps talking about final negotiations, and you brought this up a million times. How many times have we been here with this president that we are almost at the precipice of a deal and then weeks and months go by? We are more than 100 days into this conflict.
On the face of things, it looks like the president attempting to manage the optics, because the optics this morning aren't great for the president. Over the weekend, Iran striking Israel. The president saying don't strike back, and Israel doing just that.
The president, according to the FT, said that Bibi won't have any choice. I call the shots. That's what the president told the Financial Times when it comes to Israel. I call the shots, quote, he doesn't call the shots, speaking of Netanyahu. Well, then Israel decided to fire back. And it looks like potentially this administration doesn't have control or doesn't have the same sort of push they can have with Israel the way maybe they did in the past.
In the world of tech, it's Jensen attempting to call the shots. Check out equity futures this morning. Across the board, we've got a bounce on the S&P, on the Nasdaq. I said the S&P, worst day of the year so far for the S&P 500. For the Nasdaq, you've got to go back to April of last year and all the stress and tension, all the jitters around the trade story of April 2025. For the semis, the worst single day's price action going back to 2020, a 10% decline. The Nvidia boss saying this morning, you should be very happy because now you can buy at a discount.
Yep, everyone should be very excited, according to Jensen Huang. This is what he told reporters. He's actually in Seoul. He just did a deal with the SK Group. So he's saying if you have missed out on this massive AI bullish trade, now is your chance to get in. You should be happy. Basically, he's saying, Jonathan, buy the dip.
Well, here's the bounce. Forget the dip. Up 1/3 on the S&P. Coming up this hour, we'll catch up with Chris Harvey of CIBC, with stocks looking to rebound from the latest AI-driven sell-off. We'll speak to the former U.S. Defense Secretary Mark Esper on fresh strikes between Israel and Iran, and the Southwest COO, Andrew Watterson, as surging fuel prices wound the airlines. We begin this hour with stocks bouncing back following a 9-week winning streak disturbed just Friday, by the biggest one-day loss that we've seen for the year so far. Chris Harvey of CIBC, recently raising his year-end price target on the S&P to 80.20, writes the following: there is still plenty of runway for the market, but that does not preclude aggressive near-term pullbacks. Chris joins us now for more. Chris, good morning. Good to see you.
Good morning.
80.20, where did these price targets come from? 7007, 80.20?
We get a little bit of ability to round, right? We were around 8,000s, 80-20, 80-20 rule. I can remember that. But at the end of the day, we were looking for 17% EPS growth, about a 22 multiple, and that's how we get there.
Fundamentals supportive. You mentioned the earnings. The earnings have been fantastic.
Yeah.
But anyone who's looked at the technicals have come on the program, and you would share this view, I'm sure.
Right.
Technicals have been really stretched. Is that what's squeezing us at the moment?
Listen, we had a great run, right? Friday or last week, we had real rates going higher. We had more hawkishness. We have a price hike in the marketplace. You're rolling into the weekend. We don't have anything solved in the Middle East. You're right. We keep hearing all these promises, but we don't have resolution. And people are worried that something bad could happen. And you have a little bit of a meltdown on Friday.
I'm going to borrow your phrase, sleeping on the macro. It was a phrase you used at the start of the year, saying this market was too buoyant, bad things can happen. And they did for a moment, and you were right. And then you brought in a much more aggressive, constructive view on the stock market near the lows. Now you look at the stock market now. Can we use your phrase again, sleeping on the macro? Are we sleeping on the macro?
No, I don't think we're sleeping on the macro. I think everyone has their eyes wide open about what can happen, right? What we're doing is we're trying to price in two really diametrically opposed views. One is, can oil go to 125, 150? Right? Would the Fed start hiking rates, or are we in the process of a melt-up where we get resolution in Iran? We can talk about not so much easing, but pricing out that hike. And we have M&A, we have IPOs, storied IPOs, we have incredibly strong fundamentals, and valuation, while not cheap, are not excessive like they were in the 90s.
You say in your note there's more room to run, but it's not free of risk.
No.
What for you are the biggest risks right now?
The biggest risks really are rates and what happens in the Middle East, right? If things get out of control and we're starting to look at 125 to 150 on oil, that's not good, right? And you were talking about it before. We feel like the administration feels like they have control, but then you see certain things where you're like, oh, I'm not entirely sure. So that's probably the biggest issue, and with rates going higher, that could be a big problem.
Well, in the Middle East, what if we just stay in this paralysis till the end of the year?
So we stay in this paralysis, but you start getting ships through the Strait of Hormuz, and we have all other alternatives, that's okay. But if we can't get ships through the Strait of Hormuz and we start to see that step up, that's the real problem.
There were two words that slipped out last week, and I haven't heard much follow-up on it since. The president said Labor Day September. And I just wonder where that came from. Why was the president talking about Labor Day as being the potential spot for these issues to be settled?
Because potentially they're thinking about and strategizing within the White House. Now, I'm just inferring here that it is going to take the entire summer to reach a negotiation and a deal with Iran, which would make sense if you know anything about the Iranian regime, whether or not it has been decimated and we're dealing with new individuals now. It is still the same regime, even though it's changed. It took 20 months to get the JCPOA done, 20 months. So we're talking about potentially a longer road ahead when it comes to this White House and Tehran.
Chris, where does it leave this Federal Reserve next week?
It leaves them in a tough spot. I don't think you're going to hear anything too unusual from Warsh. I don't think he can really go out there and make some strong statements. I think what he's going to do is he's just going to lay the groundwork for the new Fed. Here's what you should expect from communication. Here are the things that we're watching. Here are the things we're concerned about, and here are the things that we're not concerned about, and just really give you a template for the next couple of years.
They're looking to tighten things up, maybe, just in terms of their communication, not the actual policy, and that could happen next Wednesday. Before we get there, we've got a major IPO taking place this week.
We do.
We're pricing SpaceX, should start trading on Friday, and the market's starting to push back against the offering from Alphabet, push back against just the report that Meta might be considering doing something similar and raising equity capital. I asked Cameron Dawson this question in the last hour. I'd love your reaction to it. If corporate America, the very best C-suites on the planet, are telling you now is a good time to sell equity, why is it a good time for investors to buy it?
So it depends on your definition of equity, right? So you have a very broad equity market. There are always good valuations in the equity market. Does that mean that you should be buying the froth and speculation? No, that's not our thing. Are there lots of good risk rewards out there? Yeah, and you can find those in industrials. You can find them in consumer. You can find them in technology. And if you're looking longer term, there's still plenty of opportunities. But this is not the time to light your hair on fire.
Do you think this market can stomach the degree of supply that we could see on the equity side? Not on the debt side, we've seen lots of that, but on the equity side in the year to come.
So, John, I always go back to 1998. 1998, you had Global Crossing and Level 3 come public, right? We had a pretty big pullback, but that was related to long-term capital. And then we had 99, where things continued to run until early 2000. So can you handle it? Yeah, you certainly can. And what I would also say is that in 99, 2000, you actually had a tightening cycle, and stocks still went higher. The NASDAQ during that tightening cycle was up 60%. So there is precedent for that.
But you don't think we're there yet?
No, we're not. We're not there yet. You have to have a couple things fall. We do need to have some better comfort level on what's happening in the Middle East, and that we can move forward with that. And right now, what we're seeing is, we're seeing a ton of really attractive M&A activity. We are seeing the IPOs. We'll see how they play out. The underlying fundamentals still strong, and consumer sentiment while everyone wants to talk badly about the consumer's still holding up okay.
Well, the consumer's talking badly about the consumer sentiment, rock bottom at the moment, and doesn't seem to be improving anytime soon.
They're still spending, but they are definitely going into polls and surveys talking about how frustrated they are with higher prices. And you see that consistently.
I think we're all frustrated with talks in the Middle East right now. Chris Harvey of CIBC is going to stick with us through the hour, I'm happy to say. Chris, looking forward to catching up on more topics, including this one. The president, in the last hour, suggesting that both sides, and both sides being Israel and Iran, are looking to do an immediate ceasefire after seemingly losing control of the situation over the weekend, where Iran struck Israel. Israel was told not to strike back and did just that.
They did just that, which is why the president now is putting out this truth saying that they're going to do an immediate ceasefire. The issue is we need to hear from the Israeli government and the Iranian regime that actually they are signing up for the ceasefire, and they potentially means also that they're continuing these talks with the United States. Given the fact that we've had some pretty big escalations the past 24 hours, I would like to know where exactly we are right now in terms of the negotiations between Washington and Tehran.
So crude bouncing this morning, but off-session highs following those comments from the president. We've still got WTI around 93, round it up to 94, and Brent crude around 96 this morning. Let's give you an update on news elsewhere with your Bloomberg brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. The U.S. Centers for Disease Control and Prevention says Africa's Ebola outbreak could become one of the largest ever if control measures fail to accelerate. The Democratic Republic of Congo on Friday reported cases jumping by 71 in a day, with 21 deaths recorded. JetBlue's CEO says travelers continue to pay for premium products as it prepares to roll out domestic first class. Lisa asked Joanna Garrity about consolidation plans at the IATA conference in Brazil.
Companies need to focus on their organic plan. And when we think about all the time we spent with Spirit trying to get that transaction done, we have a great plan. So you can obviously never say never as a publicly traded company, but we really need to be focused on getting JetBlue healthy again.
And coming up in about 20 minutes, 7:30 Eastern, Lisa will be speaking to the COO of Southwest Airlines. Apple's Worldwide Developers Conference kicking off today in Cupertino, California. The focus will be on the company's artificial intelligence strategy. The event comes 2 years after its first AI rollout was plagued by subpar technology and delayed features. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, the peace deal stalling.
We have the ultimate blockade. I don't consider that a war. My red line would be if I think I wasn't going to make a deal or if I wasn't going to make a deal fast enough.
Up next on the programme, the former US Defence Secretary, Mark Esper, live from New York City this morning. Good morning. Let's just frame this stacked week coming up. Wednesday, CPI data, last read on inflation, going into the Federal Reserve's next meeting, and Kevin Walsh's first as Fed chair. Look out for that. Look out for this. Should be pricing that SpaceX IPO later this week and trading on Friday, going into a market that got a bit jittery. This cut last Friday. Equity futures this morning looking to bounce. We're up across the board, near session highs now, up by 0.6% on the S&P, on the Nasdaq up by 1.2%. In the bond market, yields were pushing higher, now up by just a basis point, not even at the front end of the curve, as crude comes way off session highs, up by just 2%, not even on WTI to 92, Brent crude to 95. Just a few comments from the president an hour or so ago, sparking this turnaround.
Yeah, that was about 41 minutes ago. I'm looking at his Truth Social account now. The last we've heard from the president, he's saying that Israel and Iran are looking to do an immediate ceasefire, all caps. He says final negotiations on peace are proceeding subject to ignorance or stupidity getting in its way. Clearly, this president is frustrated with what we've seen in the past 24 hours. And I think that was really highlighted in this phone call he had with the Financial Times, saying that he's the one that calls the shots. And then what did we see? We actually saw Israel decide to call their own shots and fire back at Iran.
Hard to claim he was calling the shots over the weekend. Futures this morning bouncing their session highs up by 0.6%. Under surveillance this morning, the peace deal stalling.
We have the ultimate blockade. I don't consider that a war. My red line would be if I think I wasn't going to make a deal or if I wasn't going to make a deal fast enough. So we're having very good negotiations with the people that are leading the country now. We'll either have something done fairly quickly or we'll finish it out militarily.
So here's the latest this morning. Israel disregarding warnings from Washington, retaliating against Iran overnight. The president calling for the nations to stop fighting, quote, immediately, telling the Financial Times that he calls all the shots, not Netanyahu. Talking to us now, Bloomberg's Tyler Kendall. She joins us from Washington. Tyler, good morning to you. The president suggesting we're close to some kind of ceasefire between Israel and Iran. What do the other sides say about the matter?
Well, John, at this point, we haven't gotten confirmation from Israel or Iran that they are working towards what President Trump called a, quote, immediate ceasefire, as the White House makes very clear that they are trying to maintain that diplomacy is still a viable option and route on the table. Because if anything, we've only seen escalation in the last 24 hours between Israel and Iran when it comes to Israel's front against the Iranian-backed militant group Hezbollah. Now, Iran has long maintained that a ceasefire must extend to this fighting that is in Lebanon. But at this point, Israel has said that this is going to be a separate front, though we should point out that Israel and Lebanon did reach an agreement last week for an extended truce, but it was Hezbollah which rejected those terms and in part spurred this latest round of escalation. We're going to have to see where these potential negotiations do develop because, again, we haven't really gotten those indications that the White House's calls to de-escalate have been met. Amid reporting from Axios that President Trump directly asked Israeli Prime Minister Benjamin Netanyahu to hold off on retaliation, and President Trump saying publicly to NBC News that he wants to see Israel's attacks against Hezbollah be, quote, more surgical. One thing, though, John, that President Trump has made clear is that until there is a firmer deal in place, the U.S. isn't going to lift its own naval blockade, of course, leaving that threat of escalation on the table. And that has put commercial shipping and the threats there front and center. We should point out that earlier today we saw from the Iranian-backed militant group, the Houthis in Yemen, threaten that they will ban any Israeli ships in the Red Sea, which will just complicate all of these talks even further.
Tyler, appreciate the update. Tyler Kendall, as Tyler was speaking to us, we got this headline just crossing the Bloomberg terminal, the latest from Iran.
The IRGC is declaring an end of military operations against Israel. So this is just an example, potentially, what the president was talking about 40 minutes ago on Truth Social, saying we're very close to a ceasefire from the latest hostilities between Israel and Iran. Here we have the IRGC saying they are done in terms of their operation against Israel. That is good news right now.
That helps to bring down the temperature in the energy market. Yields off session highs as well. Equities taking another leg higher. Equity futures this morning high by 0.6%. The former Defense Secretary, Mark Esper, writing the following. The conflict is in a strategic stalemate with no clear path forward for negotiations. We're now over 100 days into a conflict that was only supposed to last 4 to 6 weeks. Mark joins us now for more. Mr. Secretary, welcome to the programme. Let's talk about how much control the president has over Israel at the moment, given the events of the weekend.
Well, he does have some control over Israel with regard to, his relationship through Bibi Netanyahu. But keep in mind, the political dynamics in Israel and the United States are quite different. Both leaders have elections coming up in the fall. Netanyahu directly, the Knesset has an election. But he is fighting a war in which overwhelming numbers, 60 to 70% of the Israeli people, at least, support the conflict, certainly against Hezbollah in Lebanon, but also against Iran. And President Trump's numbers are flipped. So there are different political dynamics here at play. I also think there are different end states that are desired. Obviously, Israel wants regime change, and President Trump wants to get a deal that it says no nuclear weapons or a path to nuclear weapons for Iran. So in some ways, they're on different paths right now.
Could we just talk about the latest hostilities of the past 48 hours? It doesn't seem like the ceasefire is fully broken. Do you think that these are just countries that are testing each other right now?
Well, first of all, I've been reluctant to say, for at least the last week or so, ceasefire. It seems to me it's more like a cessation or a suspension of major hostilities because, as you know, there have been missiles flying back and forth across the Persian Gulf, from the United States attacking Iranian coastal sites to the Iranians attacking Kuwait and Bahrain and other countries. And now the last 24 hours, this big flare-up with Israel. So, look, I think this is going to continue for a while. What's interesting to me as well is it seems like Iran is putting new things on the table with regard to negotiations, because now they're talking about wanting upfront $12 billion in unfrozen assets, maybe another 12 along the way. There's the threat, of course, of leveraging the Bab el-Mandeb. And we know that they've said, and as your reporter said just prior, that Iran is demanding complete cessation of hostilities in Lebanon. And I'm not sure that Bibi Netanyahu can agree to that.
Well, and also, how can the president agree to that for Israel, given the fact that, according to the Financial Times, the president said he called the shots, and then Israel actually took their own step to have this response?
Sure. And look, the agreement between over the last few days between Lebanon and Israel, which does not include Hezbollah, was that Israel would not attack into southern Beirut, into the outskirts of Beirut, unless Hezbollah attacked into Israeli territory. And we know over the last 24 hours, Israel has alleged that that Hezbollah did send rockets or missiles into northern Israel. They were intercepted. But that's what prompted this latest round of exchanges between with Israel going into Beirut, and then, of course, Iran responding. So this is a big part of this is Iran trying to defend its proxy, Hezbollah, its longest, oldest, best proxy from elimination. And you have this dynamic at play, and they're not going to give that up easily.
As the former defense secretary, the president said in this Meet the Press interview when talking about troops, saying we have a lot of people there, quote, they're very safe. Do you think our troops in the Middle East are safe right now?
Well, you're always at some risk when you're in a combat zone. But I think in terms of the status of the war, and I'm confident in the ability of our commanders to take good defensive measures, I think they're in pretty good shape. But look, war is risky. Things happen. We know, unfortunately, we lost 13 service members already. That's 13 too many. And several hundred have been wounded. So we can't forget about that as well. So, look, it's not risk-free, but we're not in a hot war that we were 2.5 months ago, per se.
So do you think our troops right now are just there to set a deterrence when it comes to the Iranian regime?
Well, it's a combination of deterrence. It's you also are supporting your diplomatic efforts so that the Iranians know that we can back up whatever we say with military force, or if things break down, or if the Iranians lash out again, that we're there to back it up with military force. So there are a number of reasons why we're there. And, of course, for a long time, certainly during my period, we've kept over 40,000 troops in the Middle East, regardless of what was happening. So now we have a plus up there, mostly with regard to Air Force and Navy, and I suspect they will stay there for a while until this is resolved, which doesn't appear to get resolved, won't appear to get resolved anytime soon, frankly.
Mr. Secretary, when you are at the Pentagon, you go through a lot of scenario analysis, without a doubt, and I'm sure this was an event that you spent time on in the past. How does this play out in your mind, and what kind of preparation have we made for this enduring through the summer?
Well, I went through this scenario a few times, or at least this drill with the president in the Situation Room. I talk about it a lot in my memoir, where you'd have folks who wanted to go to Iran, wanted to strike Iran. And I would at least say two things. First of all, Mr. President, a war is easy to get into, but hard to get out of. And secondly, if we want to do this, it's going to take a lot of preparation, weeks of preparation to get all the troops in place, whether it's Army air defenders, Air Force fighter squadrons, or Navy ships. And so it does take a preparation time. And, of course, you always want to bring along as many allies as you can to support you, preferably some of the European militaries, but certainly the Gulf allies. Obviously, we know that the president started this at the end of February of this year when talks broke down in Geneva, and there wasn't a lot of that preparation going on. So obviously, they've kind of shored some of that up in the meantime. But you go through at least those steps of preparation when you're looking at a possible major conflict with a country like Iran.
It's certainly difficult getting out of this time around, that's for sure. The former Defence Secretary, Mark Esper. Mr. Secretary, thank you, sir. Appreciate it. If you're just joining us, welcome to the programme. Take a snapshot of Brent crude in just today's session alone, around 4 a.m. Eastern Time, trading with a 98 handle, up 5% on the session, now back down to about 94 and up by 1.6%. As the latest reports coming out of Iran suggest the operation against Israel, at least for now, is complete. Up next on the programme, Southwest COO Andrew Watterson, as surging prices weigh on the airline industry. The bulls have had it so good, a 20% move off the low on the S&P 500, 9 weeks of gains. We give some of it up, some of it, with the first weekly decline since March and the biggest one-day loss of the year so far. The S&P down by 0.7%. On the Nasdaq, we're up by 1.3 and up by 0.7% rather. Used to saying down after Friday's drastic price action and the moves low we've seen. In the bond market, check it out, yields improving, and by improving I mean off session highs, just about unchanged now on 2s and on 10s. 10-year bond yields up by only a single basis point this morning at 4.54. Crude helping out the move. Brent crude from 98 to 94 in just a single session. In fact, in just 3.5 hours. 94.40 this morning. We're up by 1.4% on the session so far, following a few comments from the President of the United States and then really supported by some reports coming out of Iran.
Yeah, a stunning move by oil. Basically, the president is saying that there would be this immediate ceasefire. The president did say that he was the one that was calling the shots, according to the Financial Times, and that Israel wouldn't respond. Israel did respond, but it does seem like the president is influencing the situation right now. First, his Truth Social saying that this would be the end of hostilities, at least the most recent hostilities we saw in the past 24, 48 hours, and then the IRGC declaring that they are ending their military operation against Israel. So right now it does seem like we are just back to that feeling of normal, that very fragile, brittle ceasefire.
Futures session highs up by 0.7% on the S&P. That's the price action on our radar this morning. Israel retaliating against Iran, ignoring warnings from D.C. The president telling the Financial Times that Israel will have to accept any deal between Washington and Tehran because he, quote, calls all the shots. Elsewhere, AI concerns leading chip stocks to their worst day in over 6 years on Friday. The Nvidia CEO, Jensen Huang, saying the sell-off creates a buying opportunity.
With respect to the stock price, everybody should be very excited. They can now buy stock at a cheaper price. And it's absolutely true that the future of AI is very bright.
The Nvidia boss adding that the AI build-out is still in the early stages. And finally, the president suggesting the government could take ownership stakes in AI companies, finding common ground with the U.S. Senator Bernie Sanders.
I've been talking about it for the last year. When Bernie Sanders lost, you know that I got many of his people. They voted for me because we are on an economic plan. As far as economics is concerned, we have certain things that aren't that far apart.
Annmarie catching up with the president over the weekend.
So he's looking at me and saying, do you know? And I wanted to be like, yes, of course I know. And the most famous one, obviously, is Joe Rogan, who was a Bernie bro and then obviously a huge endorser of the president. This is where the far right and the far left are now colliding. And the president also made news with us reporters on Friday saying that he's going to have the CEOs of the AI companies come to the White House. And they've already had discussions of this. He called it concepts. We're back to concepts of a plan. But basically, it's some sort of partnership with these companies. Bernie Sanders has come out and talked about 50% outright equity stakes, that the government needs to own them. Interesting. David Sachs used to work with the president. He does not like the idea of this. He's saying, of course, we want China and the rest of the world to be addicted to our technology, but we don't want a CCP style of actually owning these companies.
Which one is it? Is it taking stakes or buying stakes? Is it OpenAI selling something or giving it to the U.S. government?
It's unclear right now, and I think it depends.
It's a massive difference between the two.
I know, and I think it depends who in Washington you ask what they would be pushing for. I'm pretty sure Bernie Sanders just wants them to give the United States government these stakes, and his argument is that these AI models are trained off all of our collective knowledge, whether it's news articles, our culture, et cetera, et cetera, et cetera.
Chris Harvey still with us of CIBC. Chris, is this about sharing the gains or preparing to share the losses?
I don't think it's a good idea for the government to get involved in business to a large degree. If you want to share some of the gains, then go out and tax it. Do not get involved in the ownership of it. I don't think that's a great idea.
Why do you think OpenAI is even considering it?
I don't know. You know, that's a great question. I don't have a great answer for you.
Well, that makes me think that, to your question, they want to make sure the U.S. government is backstopping them to share if there isn't any losses, or they're trying to get ahead of what they see on the horizon, which is going to be serious regulation of these companies.
That would be the less favorable way of looking at it. It's about sharing the losses.
Maybe sharing losses, maybe it gives you some credibility, maybe they think it gives you a leg up on others, maybe it gives you, they think they gives it access to certain contracts or other things. Again, not clear to me.
Intel has done very well, though, since the 10% equity stake from the government. So potentially, why wouldn't this be a good idea?
I don't. I think I believe in a separation of church and state. I believe in such separation of politics and business, and we just don't want to marry the two.
To your point, Chris, why not just hike up corporate tax rates? Why not do something on that front?
Yeah, if you're looking for gains, then that's what you do. That's your government. That's your right to do. And if you think that there's opportunity there, and you think that you can get this legislation through, then that's the path they should go down.
That's a risk factor also for the broader equity market. Is that on your horizon just yet, or is that further down the road?
A tax raise? No, that's not on my horizon. That would be a new risk. And if we start to price that in, I think you would have to see the markets come down to really appreciate a tax hike in some of the areas where they're growing the most, because that could slow things down.
These conversations always start in extreme places, and I just wonder how spicy the Democratic primaries are going to be when this topic comes up in the next 12 months.
It's going to be incredibly spicy, because are you going to be having to chase the most extreme position on this right now, which is Senator Bernie Sanders, which oddly, which is why I asked that question to the president, is it odd for you that what you are saying right now to us reporters sounds a lot like Senator Sanders? And he said no, because we kind of line up on economic issues. Is this president basically claiming to be a socialist on economic policy?
Feels like a stretch, but I understand the comparison, at least this morning on this issue.
And this is what David Sachs had to say on Twitter. America won't win the AI race if we beat China, but end up with a CCP-style social credit system in the United States. And that is the danger as the government becomes more deeply involved in AI development and assume direct ownership and control. This is going to be one of the biggest issues heading to the midterms, and it will be the biggest issue, I think, for 2028.
Without a doubt, at least as things stand. Futures this morning up by 0.75% on the S&P. Equities doing better. Let's talk about fuel costs and inflation. Surging fuel costs leading to global airlines slashing profit outlooks by nearly half.
With the significant impact to disruption in the Gulf and the very significant impact on oil prices, we're now forecasting lower growth. Fuel bill will be about $100 billion higher.
According to the International Air Transport Association, airlines are expecting to bring in a combined $23 billion in net profit this year, down from the previously projected $41 billion. IATA holding its annual conference in Brazil. Of all places, Bramo joins us now with a special guest. Good morning, Lisa.
Bon dia, Jonathan Ferro. I am here still in Rio, enjoying the beaches, as you can see here, the incredible beach of this conference center. And I'm here with the Chief Operating Officer of Southwest, Andrew Watterson. Thank you so much for being with us this morning.
My pleasure.
So I want to start with the story that Jonathan and Annmarie were just talking about, this idea of higher fuel costs. This morning we see another leg higher. We're hearing, yes, people are concerned about oil prices, but that they've been managing through. I mean, how have you managed to offset the increased cost through raising prices, cutting routes, and potentially raising costs on charging for bags?
Yeah, so you need to cover the extra costs from higher fuel. You can't do it in a matter of days, but you can organize yourself to do it in a matter of months and quarters. And so we have been taking actions to conserve costs, improve fuel efficiency, but also raise revenue through additional bag fee increases, through fare increases, and other demand generation activities that allow you to move your revenues up to cover that increased cost. Hopefully by the end of this year, early next.
Has it impeded your quest to become profitable and your actual ability to do so far this year?
Well, we had the highest adjusted net margin in the U.S. industry in Q1, so we restored profitability before fuel went up, which is better than the other way around. We certainly anticipate that transformation activity driving us throughout the rest of the year from a profit perspective, so we're focused on that and have more to go.
Have you been surprised by how little demand destruction there's actually been, that customers keep flying even as you raise prices?
Well, the drivers of demand are corporate profits really drive business travel, and corporate profits has held up well. And job growth we saw last week is also strong, and that drives leisure travel. So the fundamentals of demand generation are strong, and that really helps the customer overcome, increased prices.
How does business travel this year compare to last year? Is it actually more or is it less because of the higher costs?
It's incredibly strong right now. Last year in the tariffs, there's a lot of uncertainty. Businesses hate uncertainty, and so they pulled back on travel in the uncertain times. Now it's higher costs from fuel. They understand that, they can act on that, and as we said in Bernstein conference last week, we're seeing 25% growth in corporate travel from March on.
There has been some speculation that businesses would pull back on first-class travel, on business class travel, because the costs are going up to such a degree. Have you seen any signs of that?
No, we've not seen any change in business travel. If anything, it's an acceleration in March versus February. So businesses are out traveling themselves, trying to generate the revenue they need for the higher cost environment.
Going forward, do you expect to be able to raise prices further without seeing demand destruction?
Well, you certainly have to organize yourself to have the higher revenue. There's many levers you can do. In general, the higher your costs, the lower your growth rate. So you have to look at your growth of supply versus demand growth. And so as long as demand keeps growing and you can modify supply, even if it's not a direct fare increase, you can get the revenue traction you need.
Southwest was known as the place you could go for the cheapest fares. You would wait in lines in different groups, and then everybody would get on the plane. There wouldn't be seat assignments. There's been a transformation in the identity of Southwest since you took over really as chief operating officer and in 2024 with some of the activist shareholders. Have you seen a change in your customer base in a dramatic way?
Not really. What we've seen is our customers giving us more of their share of wallet. So we went from a one-size-fits-all to a pay more to get more model. So we still have a base fare product that if you're just very cost sensitive, that's for you. But we found that our customers really were eager to pay us more to have the exact seat they want, the exact product they want. So it's worked out fabulously well.
Going forward, do you expect that you are going to see increases in demand also from the economy, sort of your rank and file versus just those who can afford some of the perks?
You know, we see a broad base. We talked about a cake-shaped economy. There's actually a very broad middle of people who have the ability to travel, and they're traveling. And so when you give them a multiple price points and they can choose what fits them, you see you can really harvest demand. Economists might call it marching down the demand curve.
Going forward, do you expect that you're going to have to raise prices further?
I think we're going to have a mix of revenue-enhancing opportunities, whether that's on the price side, capacity changes, or other fee changes. And so the big changes in prices, I think, happened in March, and now it's more incremental type changes you have to do to kind of capture.
How much more can you charge for? I mean, yes, drinks, sure, baggage fees, going to the bathroom. I mean, honestly, at what point can you sort of run out of things to monetize?
Well, yeah, as demand growth happens, that puts natural upward pressure on revenue. So you can see as customers get raises, as businesses get higher profits, they can afford a little bit more. They end up paying and budgeting a little bit more. So now we're in kind of the gradual grain of price increases versus like kind of the big one we had to begin with.
You know, we were talking to the United CEO, Scott Kirby, yesterday, and he said he wasn't surprised by the jobs report that we got on Friday based on how much he had seen an acceleration in demand into the summer. Did you feel the same way, that you actually see a reacceleration rather than some sort of deceleration in response to higher prices?
Yeah, March saw a big inflection upwards. And so March, even though the war was kind of hot and heavy at that point, we saw a big acceleration in both business and leisure travel demand. So the U.S. economy is roaring, it seems to us.
Do you think that the inflationary inputs and what you're experiencing in terms of the costs that you're paying are also going up at an accelerating pace?
They're modest to us. And maybe if you're the Fed chairman, you think differently. But for us, the changes in compensation, the changes in input costs, ex-fuel are modest.
Meanwhile, there has been an issue with respect to deliveries of planes, Boeing in particular. We've heard of some of the issues and how that's crimping plans. How do you see that resolving? I mean, how much has that put a damper on some of what you're planning going forward?
I give big kudos to Boeing. A few years back, it was not their finest hour, but now they're delivering us a quality aircraft on time. So we're pleased with what Boeing has given us. And the MAX 7, which has been much delayed, is seemingly very close to certification based on what the FAA administrator said. So we're very pleased with how Boeing's moving along.
Meanwhile, we did hear from IATA that you are seeing profits crimped pretty significantly for airlines. It doesn't seem like that's what you're saying at all. It seems like you've been able to offset and recoup all of the oil price increases in terms of your other measures. Have you seen any impact to your growth trajectory? I know you said you've got to pull back some of your expansion and your growth, but with respect to profitability, have you seen any kind of deterioration in that?
Well, higher fuel does lead to lower profits, and so really the question becomes for next year as we get into the late summer, early fall, and it's business planning season for most companies for the following year. And so where will oil be? What will the trajectory be for next year? That's when you'll be able to understand, well, what's my growth rate next year? How does that impact everything?
Do you think that oil prices need to come down for your company, for the broad industry to be okay? Or do you think that they could stay here in perpetuity and end up with a pretty healthy airline sector because of the demand and consumers' ability to absorb higher costs?
Over the last decade plus, we've seen airlines be able to adjust to high fuel environments. We've also seen the high fuel doesn't last forever. So it will come down. The question is when, and we can organize ourselves to kind of meet that glide slope down of fuel price to restore profitability. So whether it returns to where it was last year or if it stays higher for longer, we can organize ourselves, and the uncertainty is much less than one might imagine.
Andrew Watterson, thank you so much for being with us. That is Andrew Watterson, the Chief Operating Officer of Southwest, talking about how business travel continues to be strong as people send their correspondents, their anchors, to places like Rio de Janeiro. Jonathan Ferro.
I'm not jealous at all. Doesn't it look like Bramo had a nice weekend on the beach?
Yeah, I mean, it looks like Rio's doing her well.
You wear it well, Bramo. It's good to see you.
Having a good time.
Yeah, let's see if you come back in a couple of days' time.
It's good to see you, too.
Yeah, Lisa, thank you. I get a feeling she's going to take the week off.
No, what a great place for the airline industry to have this. At the same time, they're talking about profits are going to half this year because of full fuel costs having to jump.
Chris Harvey had my favourite phrase of the last 6 years. Do you remember that? Spring break for adults.
Spring break for adults.
Coming out of the pandemic.
Yeah. It was a great one.
Things have changed, haven't they?
A little bit.
The window on that's closed.
Things are getting a little tight nowadays, and you're right. Everyone's talking about higher prices, but they still go out and spend. Everyone you talk to, I can't believe these prices. Can't wait for prices to come down. Are you spending? Yeah, I'm
Mixed
spending.
tickets feels like a stretch, though, Chris.
A little bit, at least
just
for me.
a bit.
The president says that's life.
That's life.
That's life.
But it is life. Some of us can't afford $6,000 tickets to a sports game.
That's life. It's
that is
semi-free,
life.
not free, semi-free on television.
Got to pay for TV still. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thanks. Iran-backed Houthis in Yemen have declared a ban on Israeli ships in the Red Sea, threatening a key bypass route to the Strait of Hormuz. The move comes as the Iran war moves into a fourth month and hostilities flare across the region, threatening to derail the fragile truce. OpenAI is planning a major platform overhaul ahead of its IPO as it steps up competition with rivals, including Anthropic. The Financial Times reporting the company wants to turn ChatGPT into a comprehensive super app. In sports, Alexander Zverev has his long-awaited first Grand Slam title. The world number 3 player winning the men's singles final at the French Open in a 5-set thriller. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, Wall Street laying out the red carpet for SpaceX.
Why SpaceX public now?
We're embarking on a massive new growth phase, and we need capital for that. Another thing is the revenue, I also feel pretty good about the revenue projections.
Up next, we'll catch up with Erica Najarian of UBS. Session highs. Here's the bounce, up by 0.6% on the S&P 500 this morning. On the Nasdaq, up by 1.2. Under surveillance this morning, Wall Street laying out the red carpet for SpaceX.
Why SpaceX public now?
We're embarking on a massive new growth phase, and we need capital for that. Another thing is the revenue, I also feel pretty good about the revenue projections. Before, revenue was a little unstable.
Here's the latest this morning. SpaceX set to begin public trading on Friday. Wall Street's biggest banks expecting to rake in about $500 million from the record-setting debut. Joining us now to discuss, Erica Najarian of UBS. You've got buy ratings on these guys. It's good to see you. On JP Morgan, on Morgan Stanley, on Goldman. How much money is going to be made this year?
Okay, before SpaceX, here's how the quarter is shaping up. Equity capital markets is up 65%. Right. If you just run rate what's happened since Friday for the entirety of the quarter, advisory's up 20 and debt capital markets is up 15. So I think it'll be a happy holidays for those large bulge bracket banks.
So Erica, quick question.
Yep.
Let's just make believe that SpaceX goes okay, but just okay. Do we have to worry about other deals getting pushed back or scuttled for now? What do we think going forward?
So, Chris, that's a great question. What we're seeing right now is just the top, right? The capital markets activity has been concentrated on large, mega deals. Right. And what's actually happening in the pipeline is you still have a lot of sort of mid-sized companies that are waiting to come out. Additionally, the sponsor community hasn't really tapped the market at its all-time highs quite yet. Yeah. And given that the rate hike that's now priced into the curve, you would think that now would be the time to monetize in the capital market. So there's actually a more broad-based look to the pipeline that I think that if some of these mega deals did just okay, that's not necessarily going to interrupt the flow into the market.
Okay, well, one other question. Can you frame out so the enthusiasm is almost as much as the enthusiasm for the Knicks right now, right? How would you frame this out? Is this the biggest deal you've ever seen? Or is this like, it's at the high end, but I've seen better?
I mean, let me just take a step back. We're kind of at like, the valuations aren't reflecting it, but we're kind of like at peak bank.
Right.
I mean, this is the biggest IPO that we've seen. But the rest of the capital markets activity underneath is good. Main Street is actually great. The direct lending data continues to be superb, right? And nothing is as harmful as rates at zero, right? So whatever happens to the curve, the banks are doing okay. So, yeah, no, I think it's a good time to be in financial services right now, particularly as a bulge bracket U.S. bank.
It's a good time to be Goldman Sachs. It's a good time to be Morgan Stanley. Both those names are up by close to 20% year to date. But then if you listen to what you've just said and what we've just seen in those two names, you'd expect something different maybe from JP Morgan and Bank of America. They're down on the year. Why are they not keeping up with this rally that we've seen so far year to date in those two big names?
So that's a great question. I think part of it is just that Goldman and Morgan are the purest expression of capital markets. Whereas given the war and in the Middle East, you're also worried about the consumer, right? The consumer stocks are down 20%. And obviously, Chase and Bank of America have large credit card portfolios. So in a way, I think they haven't kept up because they're not as pure of a representation of all the activity that's going on. That being said, I do think that JP Morgan, and they're never like underrated, right? Like they're a little underrated here in terms of what they can deliver for the quarter. So you sometimes you have to root for the underdog.
Right.
First, Jamie Dimon called Elon Musk Einstein a few years ago. Now he's saying he's the Edison of our time. Have you ever seen Jamie Dimon fawn over another executive the way he has been fawning over Elon Musk?
I haven't seen Jamie fawn over anything.
But he is.
Yeah, for sure. But look, I mean, he knows how his bread is buttered, right? And he is the world's top executive, for a reason.
He's not going to talk to us like that. We're not clients.
No.
Right? And that's the major difference.
Totally. And I have spoken to him before, and he'll be like, oh, reporter? No, thank you.
Right.
But at the same time, have you ever seen him talk to a tech executive like this in public?
It's pretty unusual. Are they lead left on this? Because they're acting like they are.
No, they
Isn't
are.
that unusual?
Yeah.
That piece of it's unusual.
But look, I mean, remember, SpaceX could have, continued needs from here as it tries to expand, beyond Earth, right? And so, the first Mars IPO, who's going to sign up for that one? And the Mars Exchange. But look, I mean, that's the business.
You said bet on the underdog. Kind of laughing because JP Morgan's no underdog.
No.
Strange they've become that, though.
Yeah, but
in that group of stocks.
Yeah, but look, I mean, I think that's an opportunity. Right? JP Morgan is never priced as the underdog, but Goldman and Morgan have literally gone like this for this year, right? So I feel like that's a less expensive way for folks to invest in this capital markets renaissance of sorts.
Going to slide into the DMs. Is that the suggestion here?
Well, that was going to be my suggestion. Jamie Dimon didn't get to Elon Musk's DMs fast enough.
Sign up to X.
I don't think Jamie has to slide into anyone's DMs, to be quite frank.
Erica, it's good to see you. Thank you. Appreciate it. Erica Najarian there of UBS. Chris Harvey, good to see you, sir. Thank you. Chris Harvey of CIBC. Up next, we'll catch up with Sarah Hunt of Alpine Saxon & Woods, Crispin Love of the Piper Sandler Group, Nathan Sheets of Citi Research, plus Yoder of JP Morgan Private Bank. The third hour of Bloomberg Surveillance just around the corner.
The market is strong because the economy is strong overall.
Ultimately, what's going to drive this market higher is going to be the AI trade.
I think that the entire market is one trade, and I think right now we're in the boom part of the trade.
Certainly tech or AI has soaked up all the oxygen in the room here.
We're forgetting that there's a lot of other industries.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your price action scores look like this. Friday, the losses. This morning, the bounce up by 0.7% on the S&P, on the Nasdaq up by 1.3. Similar move on the Russell. This morning, things were looking a little jittery in the bond market. Yields were higher across the curve. Things have settled down. Twos unchanged at 415, 10s at 453. Crude was up 5%. 98 handle on Brent, right now 94 and up just 1 percentage point, following some soothing words from the President of the United States.
Yeah, the president entering in terms of the market, in terms of rhetoric, some nice words saying that Israel and Iran are looking to an immediate ceasefire. And then it was backed up by the IRGC, according to FARS, the IRGC declaring an end of their military operations on Israel. So this very fragile ceasefire that we have right now in the Middle East does seem to be holding on, which is kind of crazy to say, even though we did have ballistic missiles heading towards Israel and Israel striking targets in Iran. It does seem like at the moment, all sides want to hold on to this ceasefire.
Taking some heat out of the energy market, bringing yields back in and helping equities rally just a little bit more on the S&P 500 and on the Nasdaq into this. Through this week, tons of economic data, CPI, the headline event on Wednesday, and an IPO set to price later this week. Not just any ordinary IPO, the biggest initial public offering this market has ever seen.
This is going to be huge when it comes to SpaceX on Friday. We were just talking about that with Erica and how all the banks want to get in on this because the fees are going to be astronomical. Something me and Lisa and I have been talking about for the past few weeks. Where are investors taking money from to make sure that they can get in on SpaceX, then on Anthropic, then on OpenAI, and how difficult is the SpaceX IPO going to be potentially for the market if we get a really hot CPI print this week?
I call it the supply monster. We're choking on supply. Alphabet coming out last week with an upsized equity offering, equity capital raise of around $85 billion. And the mere report, I think it's important on Friday, the mere suggestion in the Financial Times that Meta was considering doing the same thing sent that stock into a nosedive into the close on Friday. On top of that, that's just the equity side. Then you've got the IPOs coming, not just SpaceX, but Anthropic and OpenAI potentially later this year. Then you've got the debt side. Talked about this number a few times. Pricing $1 trillion of IG debt in this country in near record time. So you've had it on the equity side, on the debt side. And how close are we, how far away are we from some real indigestion here, from all that supply coming into this market on both equity and debt?
And you're right to bring up Meta. I think a telltale. The market didn't digest it the way they originally digested Google. What I found so interesting about Google, $80 billion wasn't enough. They came back and said, actually, we're going to up it and do a little bit more, $5 or $6 billion more. But potentially, there is going to be a point where the market says, okay, we can no longer tolerate anymore.
Doing better this morning, up by 0.7 on the S&P. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods. Following a 10% rout in chip stocks on Friday, Nathan Sheets of Citi raising his policy rate forecast for global central banks, and Abby Yoder of JP Morgan on why the market pullback is a healthy sign. We begin this hour with stocks bouncing back following the biggest one-day sell-off this year. Sarah Hunt of Alpine Saxon Woods writing June is busting out all over. The market has taken the better data so far as a sign that the Fed will, at the very worst, hike rates once by the end of 26. Sarah joins us now for more. Sarah, good morning. Good to see you.
Good morning.
Are we about to go through a period of indigestion here with all that supply coming?
I would not be surprised. I mean, it certainly looks that way. And if you see the way that the reaction was, to your point, on Meta on Friday, and the fact that, you know, they came out so quickly and said, hey, we're going to raise some equity before these big IPOs come, I think there is a concern that there is some question about how much appetite there is for a lot of this.
And on top of that, you might see tighter policy out of the Federal Reserve. That put the squeeze on this market big time on Friday. Jobs came in hot, started to price in a rate hike, not for next year, but for this year. Could that tighten things up too?
Well, I mean, it's interesting because if you look at the WIRP function, I think it's much more a snapshot of what the sentiment is today because it hasn't actually played out very well. If you go back and look at where rates were pricing out further along the last year and a half, it's been wrong more than it's been right, but it definitely gives you an idea about where people are thinking right this minute. And right this minute, that data combination plus the inflation and the concerns that are coming this week with inflation was absolutely one of those moments where everybody was like, oh my God, we're going for hikes, not cuts.
The Federal Reserve, so far at least, up until then, has been a reason to be bullish. This Fed seems to be behind the curve compared to other central banks. The ECB is gearing up for a hike later this week. The Bank of England might follow. We're still talking about the removal of an easing bias and a Fed going to neutral not shifting to a hawkish bias, but a Fed going to neutral that wants to articulate to this market there is equal chance of a rate hike or a rate cut as our next move. Is that still constructive?
Well, I think it's reality, right? Because hiking rates here isn't going to solve the problem of oil supply shocks. And that's one of the reasons that inflation is so high. So do we have a big demand problem? Well, high prices tend to cure demand issues, right? So that is going to shift on itself. And cutting rates at the moment, you don't have a labor supply that's in terrible shape. You don't have an economy that's in terrible shape. The data's been pretty good. I think neutral's not a terrible place to be fair. But I also think that it's one of those things where it's a fine line between neutral to, oh, maybe it's this way or, oh, maybe it's that way. And I think that there's still a lot of cross currents.
How important is going to be this CPI report this week, given how the market reacted to Friday's jobs number?
I think it's going to be very important, and I think it's going to be grim. I mean, I think that there's no way that you're not starting to see some of this bleed through, because energy prices bleed into everything eventually, and the fertilizer prices bleed into food prices. There's a lot of things that are happening because of that.
Fertilizer prices are up big time. I mean, it's why the president went to the 3rd Congressional District in Wisconsin. Yeah. And these farmers are dealing with incredibly high prices.
Right, and it's one of the things that doesn't get talked about enough in the scheme of things about what else is bottlenecked within the strait. But those things also take a long time to work out, because if your prices are much higher this year to plant and to a whole lot of other things, including diesel prices, which are very high, then that doesn't resolve the minute the prices come down, because you're spending that money today, so you have to recoup it tomorrow. So I think that there's an issue there.
What does a grim inflation print mean for the equity market? Also grim?
I don't know, because you would think that it would be, but at the same time, the equity market is showing an enormous amount of resilience. I'm surprised to see that it's showing some resilience this morning, given the fact that the Kospi was down over. I mean, I'm surprised at how we're looking green already, and there's still some stuff going on.
You're expecting some negative follow-through from Friday this morning.
Well, I was looking at the Kospi and thinking that there might be. So, I think that there is. I mean, that was also a very stretched situation. I mean, even more stretched, you could argue, than the semiconductors in the United States. But I think that there is. I mean, I don't disagree that a pullback is healthy. The question is, did we get a pullback, and do we now have some calm? Do we have a lot of chop for the next few weeks? Maybe we do. That would not be so bad. I think the concern is that you get something where things start to go down and it spirals on itself.
What do you think was more important this morning? The president saying there's going to be an immediate ceasefire, or Jensen Huang saying you should be excited by this dip?
Well, I mean, they're both talking their own book, right? I mean, and to the extent that they would like a ceasefire, absolutely. I think it's been very clear that this is something that they would like to see calm down a lot. And I think that Jensen completely believes in Nvidia and thinks it's a great stock and thinks that it's a great opportunity. I don't think that either one of those things are necessarily wrong. Whether or not they are meeting what's actually happening on the ground is, up to...
Well, let's talk about what's happening on the ground. We've been talking about this for the last 2 hours now. The Alphabet capital raise last week, and the mere suggestion that Meta was considering the same in the Financial Times, sending the stock lower. I just wonder how much weight I should put on that price move, because that price move to some might signal, hang on a minute, this market's starting to push back. And these companies have raised a lot of money that have funded the gains in the chip sector, and now the stock market's pushing back. Shouldn't I pay a little bit more attention to that?
I think that there's a lot of things that are coming up that are going to be either positive or negative evidence in that direction. I'm not quite sure we're there yet. I mean, Meta's had its own issues with the market and the way the market looks at what they're doing. So I'm not sure that they are the canary in the coal mine, but I do think that people are raising a lot of money. And all of this CapEx that we're talking about is coming from a no longer cash flow situation, and it's coming from a debt and equity situation. And can they afford to do that? Is that going to be the bottleneck? Forget memory, forget some of the capacitor situation. Is it going to be, can we raise the money fast enough? And I don't know what the answer is. Yeah.
The capital constraints, the potential for them, the pushback in both debt and equity. You're seeing signs of it emerging, signs of it building.
I think that is, as we see what happens with the SpaceX IPO, as we see some of these other massive equity raises come to market, can they be absorbed? Because I think that, you wanted to get first out of the gate, which is why that 80 went to 85. It's like, well, people have a lot of appetite, so we managed to upscale it. But there was also a yield involved, so there was two different things going on there. I think we're going to see, as we move forward, how the market absorbs all of these. And it is a good question. And the fact that S&P pushed back and said, you're not getting into these indices, I think people thought that there was a natural index and passive big demand coming because of that, and now they have to recalibrate that a little bit. And I'm not sure that was the biggest thing, but you just added that to what was going on Friday.
I asked this very same question to Cameron Dawson at 6 a.m., to Chris Harvey at 7 a.m. I'll ask it of you at 8 a.m. C-suites in corporate America, the most advanced, sophisticated C-suites on the planet, Alphabet, Meta, talking about these up-and-coming IPOs. Those C-suites too, SpaceX, Anthropic, OpenAI, have decided that now is a good time to sell equity. What is the argument for investors to buy it?
You have to continue to buy the story that AI is going to continue to be the most important dominant theme over the next 5 years, that this is still a good time to be looking at that. I think the big question exactly is, now we're raising debt and equity to fund something that we were funding out of cash, which people were very comfortable with. How comfortable are they and how far can that be pushed? And we don't know the answer to that yet, but I do think that there is an enormous amount of enthusiasm. I mean, look at the space stocks and look at what they're talking about doing. It's easy to get caught up in a story of this is just the beginning of a long tail. And so you don't have to be so worried about valuations here. It's really exciting. But there's always a push, and there's always a pushback, and then there's always a question of, okay, well, what does that actually mean, and when can I actually see the return on that if you're coming to market 20 years after you've actually been in business and we're still looking for profits?
And got to pick your price for the IPO, basically, before the roadshow even started. Sarah's going to stick with us. Sarah Hunt there of Alpine, Saxon & Woods. Equity futures near session highs, bouncing back from Friday's losses, up by 0.7% on the S&P. With an update on stories worldwide this morning, with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Iran declaring the end of military operations against Israel. The two countries exchanging missile strikes overnight. President Donald Trump telling the Financial Times Israel will have to accept any deal between Washington and Tehran because he, quote, calls all the shots. Nvidia and SK Hynix are collaborating on designing future generations of memory chips for AI. The announcement comes as Nvidia CEO Jensen Huang visits Seoul for meetings with his company's Korean partners. And traders fully pricing in a rate hike by the end of this year following Friday's blockbuster payrolls report. President Trump weighing in.
There's no reason to raise interest rates. I don't want to kill success. We should actually lower interest rates. Now, I would like to see rates get lower because we could build this into the greatest machine that the world has ever seen. But you can't do that when everybody immediately raises interest rates.
President Trump's comments coming ahead of Fed Chair Warsh's first policy meeting next week. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Crispin Love of Piper Sandler on what could be the next domino to fall for private credit. That is next from New York City with a Knicks mug strategically placed, no matter where you sit in this studio.
It's a big game.
Game three. Later this evening from New York.
I'll be there.
You're watching Bloomberg TV.
We're seeing this unwind just out of these really big overbought conditions. And what's notable is that we're nowhere near oversold. Arguably, you could say that the easy part is over, meaning the valuation reset is over. And now the question is, do you still see earnings upside for these semiconductors from here?
It never feels easy, that's for sure. Cameron Dawson there of New Edge Wealth on this equity market. This equity market this morning, a good morning to you, bouncing back on the S&P 500. On the Nasdaq, here's the bounce, up by 0.7 on the S&P, on the Nasdaq up by 1.3. Friday was awful. If you think about how bad it was, moments of stress in this market, think of April last year. Worst day since April of last year for the Nasdaq. Think of the pandemic, spring 2020. Worst day for chip stocks since spring 2020. And it follows a massive run-up in this equity market.
And that's why the president was so frustrated on Friday with the stock market declining, because he said we just had a great jobs report. The market should not be pricing in this hike. He still wanted to see a cut. Interesting this morning, we had two important individuals. First, Jensen Huang saying, stocks are down, buy the dip. You can get in. Exciting time for you. And then second, the president really, as you mentioned, soothing the market, saying there's going to be this immediate ceasefire between Israel and Iran, and then the IRGC coming out and saying they're ending their military operation, current military operation when it comes to Israel.
That helped bring yields off session highs. Twos on Friday, new highs for the year. Tens, the first close we've seen above 450 in about 2 weeks. 454 this morning, up another basis point on twos at 415. One more read on inflation ahead of the Federal Reserve's next meeting and Kevin Warsh's first meeting next Wednesday, this coming Wednesday, CPI.
CPI, this is going to be incredibly important after we had a very good, strong labor market report. I mean, it was triple of what people were expecting. The highest was, nothing close to what we got. On top of that, now people are saying potentially we're going to see a 4 handle on inflation. If you're the incoming Fed chair, and basically many people believe that you were picked for this job because you expressed an interest in lowering interest rates. How do you do that in this environment? You can't.
It's going to be a tough ask of Kevin Walsh, a weak Wednesday. That's the price section and the setup for the Federal Reserve. Let's get you some morning calls. First up, Wells Fargo, more than doubling its price target on Micron to $12.20, seeing continued upside driven by greater confidence. Your second call from Mizuho, raising its price target on SanDisk to $2,200, seeing potential for an 8-fold increase in TPUs by 2028. So many balls out there still. Their stock is up by 4% in the pre-market. And finally, KPW downgrading Blackstone's secured lending fund to market perform, citing the company's setback in credit quality. Let's stay on private credit and private equity too. Redemption requests ramping up as investors remain uneasy. Crispin Love of Piper Sandler writing, we're not surprised by the continued redemptions. Private equity needs to be wiped out for private credit to take losses. Crispin joins us now for more. Crispin, good morning. It's good to see you again.
Great. Thank you for having me, Jonathan.
Welcome back. Let's talk about what happened last week and sort of set the stage for why this conversation has started again. Partners Group. How different are the redemptions there compared to the redemptions we've seen elsewhere?
Yeah, so they're very different, where what we've seen over the last couple of quarters has been all on the direct lending side, all private credit. And Partners Group last week, a Swiss-based firm, they had nearly 10% of private equity redemptions in their semi-liquid product. So that's going to be the big focus, I think, over the coming weeks when we start to see more of the redemption data from Blackstone and others. Where is it just direct lending, or is it breaking into private equity as well? We think direct lending, that's going to be several quarters of elevated redemptions, but the other areas have been pretty strong, but private equity will be a key area to watch.
What do you think it is, the former or the latter?
So I think you could see a pickup in private equity redemptions, because what we've been writing about for a while is if you're worried about private credit, private equity needs to get completely wiped out in order to private credit to take losses. On the private credit side, a lot of these loans are 30 to 40% LTVs, senior secured. So you need private equity valuations to come down materially.
Where is the demand for liquidity coming from? Where's it coming from, and what's driving it?
Yeah, so a lot of it is coming from international, it's family offices. I do a bunch of channel checks with a lot of financial advisors, and it's really not coming from them. From everything that I've been seeing there, they're getting tons of questions from their clients, and a lot of what the financial advisors are saying is kind of stay where you are, stay the course right now, but a lot of it is that international family office side. Blue Owl made a comment several weeks ago that 50% of the redemptions are from 1% of their investors. So it's not something that's completely broad-based, but more focused. And then what you're seeing as well, a little bit of a gamification of it, where similar to an IPO, where if you want 5 shares, you're going to ask for 10, knowing that you're going to get scaled back.
Is there a loss of confidence in the asset class?
I don't necessarily know if there's a loss of confidence. I think there's a lot of uncertainty. Since September, there's been just a ton of press on it. People have been worried, and you've seen these redemptions drive up. And one thing that we look at is you saw BCred's, Blackstone's largest product, which we use as a good proxy for the industry as a whole. If you look at where you have to break out between sentiment and performance, and on BCred, a lot of the stress or a lot of the headlines started last September. So that's 8 months ago. And we look at the monthly data. Returns in that private credit product have been positive 7 of the last 8 months, and then positive the last 2 months.
If these vehicles, though, continue to have this redemption pressure, could this be like a snowball effect where it just gets much worse and broadens out?
So I don't think it can get much worse, because the key issue are the 5% caps. And that's something that we're probably going to see over the next few weeks, where you saw Blackstone last week, 10% redemptions requests being scaled back to 5%. You're going to see that over the next several weeks. But one thing that Blackstone also talked about last week is the redemptions that they're actually paying out, they're 160% covered by just repayments and inflows to the fund. So people will talk about it and compare this to a GFC scenario, which doesn't make sense in our eyes, because there isn't a liquidity issue or a liquidity crunch because of those redemption caps.
So I have a question, and you mentioned 2 things that I thought were interesting. One was the 1% and 50%, and also calling it semi-liquid, right? So that's one of the issues that I think is part of the problem. And I can understand why the first wave came on the fact that there was so much software in some of these private credit places. It's interesting that 1% owns that much, so they must be pretty big players in that if they're the big part of the redemptions. But what do you think is driving this if it's not that the underlying companies, at least on the private credit side, are no longer in as much concern that they were going the way of the dodo, which is what was happening with software for a little while?
Right, and so right now, yeah, the returns have been good, and just looking back the last 5-6 years, it seems every year we've had an issue where you had COVID, you had the Ukraine war, you had kind of supply chain problems, and now the Iran war. So you're having all these big macro events. Rates went from 0 to 5%, and a lot of these private credit funds reacted very, very well. But what these investors are looking at is there's plenty of uncertainty out there, and taking the software point, it's not what returns are or what credit quality is today, but it's looking at what's going to happen 12, 18 months down the road. And the one area that we're worried about and watching very closely are going to be these software refinances that are going to happen 2027 to 2029, because there's going to be some tough conversations where is private equity going to inject more capital into these, or are they going to walk away and hand these companies back to the lender? So I think that's going to be the key thing to watch down the road. So unfortunately for investors right now, it's not going to be resolved over the next quarter or two. You're probably going to get results going to be probably pretty good from the alternative side, but people are looking farther out, and that's where a lot of the stress and the worry is coming from.
Well, and I think that's also something that's very hard to game out, because you get these pop-ups of flares of concern. And I would argue that if we didn't have the other things that were going on, like the Iran war and what's going on with energy, this would be a bigger conversation, because people would get upset about it. But then it just went away, and now it comes back up, and then we'll see if it goes away again. Right. Where do you think the concern level settles in, or do we stay at an elevated level?
Yeah, well, it's interesting how the concern level has ebbed and flowed, where you had last September with Tricolor and First Brands, and those were bank syndicated loans. So we're away from the private credit players. But then you had companies report results, everything's fine. Then you get the redemptions, everybody's worried. And now you're kind of rinse and repeat, where you had pretty good earnings coming out of the first quarter. Now we're going through the redemption wave again. So it's going to ebb and flow, but it's just going to be something that we're going to be watching over the next kind of several months and several quarters.
Crispin, you're not alone, that's for sure. We're all watching. It's good to see you. Thank you, buddy, as always. Crispin Love there of Piper Sandler. As we're having this conversation, this headline crossed just moments ago. It came from Amazon, kicking off a 5-part Canadian dollar high-grade bond offering. Amazon, you remember Alphabet went on a 4-month, $60 billion debt binge not so long ago, and included in that debt binge was an offering in Canadian dollars around early May. Just looking for pockets of liquidity in different currencies and different pools of capital to raise more money. And we're seeing this on the debt side. Again, this morning, you're seeing it on the equity side as well.
It's like you manifested this. You were saying that we continuously see these offerings, and we're seeing it in both debt and equity. And at some point, is it going to be just too much for the market to digest?
Waiting to see if Meta follows through on that FT report that we saw on Friday. Coming up next, we'll catch up with Nathan Sheets of Citi on the economic risks that could lead to a global rate hiking cycle. Live from New York City this morning. Good morning to you all. Your price action 60 minutes out from the opening bell, shaping up as follows. On the S&P 500, following the worst day of the year, bouncing back 0.8%. On the Nasdaq 100, following the worst day since April last year, bouncing back 1.5%. On the Russell this morning, doing better, up by 1.4%. Heading into a monster IPO later on this week. From SpaceX, in the bond market, 2s, 10s, 30s, 2s, new highs for the year. Yields at the moment settling down 2 basis points now. Better news, 413. Yields were higher earlier on in the session. A new high on a 10-year, at least for the last 2 weeks, closing back above 450, 452.24. Yields again down by just a single basis point this morning, so doing better on the bond market front. Supported by this move in crude. Crude was up to 98 on Brent. It's back down to 94. Was up 5%, now up just 1. There were fresh strikes over the weekend between Israel and Iran. The sequencing of events sounds a little something like this. Israel going after Lebanon, Iran going after Israel, the president telling Israel not to do anything, Israel doing something, then the president saying we're going to have a ceasefire, and then Iran saying the operation is over.
Okay, yeah, that's the exact timeline of what happened. But I think it's important to note that the president, according to the FT, said he was calling all the shots. And then Israel decided to make that strike. And that is why it felt like for a moment there, the president was losing some of his influence on Israel. Everyone has a say in this war. This is why this feels so different than last year's Liberation Day, when the president had full control of on the lever and can dial up or dial down the rhetoric. There's 3 and many more parties, and some even now are joining when it comes to the Houthis and them not allowing Israeli vessels. Does this stretch potentially to more vessels that the Houthis are going to potentially go after Bab el-Mandeb Strait? A lot of risk, but at the moment, the president saying Israel and Iran looking to do an immediate ceasefire, IRGC basically confirming that, and that has smoothed over the concerns for this morning.
Things were looking a little bit fragile at one point earlier on this morning, around 4 a.m. when crude topped. We've pulled back since those levels. We're getting these headlines now from Amazon. I wanted to share this with you once again, just in case you missed it. The headline dropped just moments ago that Amazon is going on a 5-part debt offering in Canadian dollars. It stretches from anywhere between 3 years out to 30. This debt offering follows Alphabet's effort earlier on this year. They had an offering in Canadian dollars around May. They went on a $60 billion 4-month debt binge. That was on the debt side, and then Alphabet, of course, followed that up on the equity side of things with an $85 billion equity capital raise. So put it all together, massive offerings on the debt side, big offerings on the equity side, more IPOs coming up on the horizon. That's some crowding out we need to think about. This came from Jim Zelter of Apollo on this program just last week. You are seeing potentially long-term crowding out of this massive, long-duration capex boom around the globe and the impact on, guess what, on government debt yields. Sarah Hunt, still with us. Sarah, your thoughts on that? If we're going to see some crowding out, it's the sovereign that might be vulnerable here.
It's a very big market, and it could be one of the sources of cash. The question will be, I mean, it ties into a couple of different things. Where do rates go? Because people feel very comfortable still with U.S. sovereigns, right? Other sovereigns, it might be, you saw in the last couple of times we had any kind of sovereign problem, it wasn't usually in the U.S. It's usually outside the U.S. So I don't think it's so much the U.S. I think, but there is room to say, you're looking to raise a whole lot of money and a whole lot of debt. Where is that going to come from? And, you know, the ECB may be hiking rates. Maybe they're also, maybe that will help a little bit. I don't know. We'll see how that goes.
How accommodative is this Federal Reserve going to be? Investors gearing up for a key stretch of economic data. Inflation coming on Wednesday. Mike McKee has a preview. Good morning, Mike.
Good morning, John. It is going to be a very big week. I was thinking when you were looking through the market boards, I wonder how much the markets are going to look like today's numbers when we get to Friday. We've got inflation week ahead of us, which is going to be the key week for Fed policymakers. We don't get to hear from them, but we do have the New York Fed expectations today and the University of Michigan expectations on Friday, and the Fed keeps a close eye on inflation expectations. In between, we get CPI and PPI, and the CPI on a year-over-year basis expected to jump over 4%. If we get something like that, it's certainly going to catch people's attentions in the market, and maybe one reason that we're already seeing bonds go up, because they're anticipating Fed rate increases and they're looking ahead to this CPI number. As I mentioned, no Fed speak this week. You talked about it, blackout week ahead of the Fed decision, but we have had a number of Fed speakers express concern about the way we're going with inflation. Beth Hammack, Mary Daly, Tom Barkin even, who usually is very neutral, says AI may be pressuring the neutral rate. In other words, moving it higher as a lot of investment goes into AI build-outs. And Laurie Logan, who is definitely a hawk, saying a hike may be necessary before the end of the year. So we're going to keep an eye on that. I might mention one thing that's not on the calendar is another Supreme Court decision day on Thursday. We're still waiting for that Trump versus Cook decision, and that could have a major impact on what people think about the Fed. And of course, the first Fed meeting with Kevin Warsh as chair comes up in about 10 days on the 16th and 17th. We'll get the decision on the 17th. They're not going to do anything, but how is Kevin Warsh going to portray the economy and the outlook for rates going forward? A lot to layer on top of the SpaceX, on top of the war, and on top of the New York Knicks.
What a crazy week the next week might be. On top of the New York Knicks, of course. Mike McKee, thank you, sir. Mike mentioned Governor Cook. Governor Cook might have some implications for Governor Powell, who's still on the committee.
That's exactly where my mind went. Depending on what the Supreme Court does, what does this mean in terms of how Jay Powell thinks about whether or not or for how long he's going to stay as a governor? Because remember, this is not forever. He wants to leave at some point. He wants to wait for all these loose ends to be tied up, and that is a key one.
Nathan Sheet of Citi writing the following: markets now see almost a full hike from the Fed by year-end, nearly 3 hikes from the ECB and 2 hikes from the Bank of England. We've raised our year-end forecast for policy rates in 16 of the 27 central banks that we forecast. Nathan joins us now for more. Nathan, welcome to the programme. Does that sound a little bit like 2022 to you?
I think there's some remarkable similarities here where we're seeing distinct upside pressures on inflation. And central banks around the world are debating about what to do about it. Now, where it's different than 2022 is that they have that previous experience of miscalculating those inflation pressures. I think what we're seeing in the markets, and as we write down our expectations for central banks, is we think they're not going to repeat those mistakes that they made in the previous episode. And central banks are likely to be more aggressive. And you're not going to hear that transitory word uttered, I think, by a single central bank over the coming year.
Conditioned to make a different mistake, perhaps, Nathan. I'll ask you the question more directly. The risk last time was a dovish policy mistake. Do you think the risk this time might be a hawkish one? I'm thinking more about the ECB with that question in mind.
Well, I think as a general proposition, where the markets are pricing and where the markets are seeing the balance of the risks is about right. But there are some important exceptions there. And I think the ECB, as you point out, is a key one. And it's one that we're quite concerned about. And it's kind of a deeper examination of that previous episode. And you may recall in 2022, early in the year, we at Citi were getting very pulled up on European growth. Europe was coming out of the pandemic. We were expecting the reopening trade to prevail. There's a lot of underlying domestic demand in the economy, and we see that as a key for driving the inflation in Europe that occurred. And we do worry that there may not be as much underlying momentum in the euro area economy in this episode, and that the ECB, at a minimum, we think they need to be pretty cautious here with rate hikes. We penciled in a couple because we think that's what they're most likely to do, but we're pleading with them, please be careful here and not over-extrapolate, so to speak, those previous lessons.
Well, Nathan, what do you think of the fact that the ECB, at least one member is talking about that, forget June, we're going to hike again? They're talking about 2 in a row.
Well, that is our call. And again, it's a positive call. It's not a normative call. That once they moved in June and they've declared that the conditions are necessary for rate hikes, we think that that argument is likely to prevail again at their following July meeting. So we do have 2 in a row. We're worried that the ECB, in particular, may be overly aggressive, and as Jonathan said, overlearn those previous lessons.
So, Nathan, you've got the ECB hiking, but our friend Andrew has got the Federal Reserve cutting, which feels like quite an unusual moment. How tense are the meetings at Citi right now when you discuss the outlook for rates at the Fed?
Well, let me put it this way. When I was at the Federal Reserve, Ben Bernanke used to say that if 2 people agree all the time, then one of them's redundant. And we certainly don't have that problem at Citi Economics, where we do have a variety of views. And as you point out, our European team is a little cautious on the underlying growth dynamic, but definitely sees the ECB moving. And our U.S. team is arguing for the United States that in coming months, we're likely to see some kind of a deal on Iran. And in parallel, we're likely to see some easing in the labor markets that's going to trigger a pivot from the Federal Reserve. I think there are a lot of conditions that yet need to fall into place for that U.S. call to materialize. But as Kevin Warsh takes the helm of the economy and the consumer is a little bit softer than before, our U.S. team is quite concerned about where rates may head.
Nathan, that dovetails really nicely into my question, which is, what do you think the communication policy changes may be as we look forward to a different chair? And we look forward to, do we get a dot plot? Do we not get a dot plot? Where's your dot? All that sort of stuff. How do you see that playing out in the near term?
Well, I do believe that deep in Kevin Warsh's DNA is a belief that the Fed talks too much, and that through its over-communication, if you will, the Fed creates volatility for the market rather than understanding by the market. And I think that you'll see him at least seek to take steps to reduce the number of speeches, maybe simplify the SEP. I think another meaningful possibility is, as you recall, Ben Bernanke and Janet Yellen had press conferences only once a quarter, not after every meeting. And Jay Powell instituted the every meeting practice. And Kevin Warsh may roll that back. I think there could also be some changes in the way that the Fed talks about the inflation target. I think 2% is a noble objective for inflation, but maybe you'll see Kevin Warsh try to fuzz up a little bit which target, which inflation index is precisely the target, and instead talk about 2% in underlying inflation. And I think he's done that already, at least a bit, with his references to trim mean inflation.
Inflation, after all, is a choice. Nathan, it's good to see you. Thank you. Nathan Sheets there of Citi. Appreciate it. Not trying to start a fight between Nathan and Andrew Hollenhorst. Andrew looking for cuts still later this year. How high is the bar right now? Is the bar higher for hikes or cuts in 2026?
I still think it's higher for hikes. I don't think that we're going to get a cut, but I think it's higher for hikes because that just the regime change alone, as opposed to just saying we don't know which direction we're going, seems like a big move or a bigger move than we're going to stay in this middle ground or maybe towards the let's make sure the labor market's okay kind of thing.
The argument I've heard, I heard this from Matt Nazari at Deutsche Bank, now the base case over at BNP Paribas, is that you can basically say something like this. I'm not here saying that I'm worried about inflation pressure coming from the labour market. I'm here saying the labour market's no longer a reason to worry, at least to the downside. And we cut rates 3 times last year. That was insurance. Let's take it back. Let's take back some of that insurance. We didn't need those cuts. Now we can hike a few times. What do you make of that argument this morning?
I think it would be an easier argument to make if wage gains were keeping up with inflation, and the fact that there is a little bit that you don't see that kind of labor inflation that you might see, that you don't necessarily need to take those emergency or those, insurance cuts off the table. I think it's harder to make that argument at this moment. If wages start to move, I think it's a different game. And there's, the labor numbers are also really hard to parse because they keep changing some of the formulations, and it's hard to say what's normal now versus what's normal a year ago. So I think that that's really going to end up being more about where wages go and how people are keeping up with inflation, because that's part of the problem too.
Kevin Warsh, over to you. The Fed chair, his first meeting a week away. Let's give an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Big tech continuing its massive debt binge. Amazon kicking off a 5-part Canadian dollar bond sale this morning. Back in March, the online retailer raised about $37 billion in the US and nearly $17 billion in Europe. Apple's Worldwide Developers Conference kicking off today in Cupertino, California. The focus will be on the company's artificial intelligence strategy. The event comes 2 years after its first AI rollout was plagued by subpar technology and delayed features. If you want to go to Game 3 of the NBA Finals tonight, it'll cost you. The average price for a ticket is about $8,000. Annmarie asked President Trump what he thought of the sky-high prices.
Well, I know, but they can watch it on television. It's sort of semi-free to watch it on television, but that's the way life goes.
Trump will be at Madison Square Garden for tonight's game. Watch parties outside the garden have been cancelled for security reasons. And that is your Bloomberg brief. John.
Vonnie, thank you. Annmarie will be there too.
Yes, for work. I'm
Not
covering
bad.
the president.
Sure.
But, I'll be reporting on and be able to see who paid these insane prices for tickets, which Josh Hart, by the way, called them crazy and ridiculous.
For work, which is Bramo.
It is for
She
work.
goes to Brazil for work.
It is for work.
You know, yes, sure.
It is for
With
work.
the Knicks tonight for work. Bramo's in Brazil for work. I'll be in bed getting ready for work. Up next on the programme, setting you up for the day ahead. Plus, Abby Yoder of JP Morgan Private Bank raising her target on the S&P.
You have a very broad equity market. There are always good valuations in the equity market. Does that mean that you should be buying the froth and speculation? No, that's not our thing. Are there lots of good risk rewards out there? Yeah, there's still plenty of opportunities, but this is not the time to light your hair on fire.
Chris Harvey of CIBC on this equity market following the biggest one-day slide, biggest one-day sell-off we've seen so far this year in Friday's session. This morning, here's the bounce going into the cash open, about 40 minutes away. Equities higher by 0.8% on the S&P, on the Nasdaq up by 1.6%. Abby Yoder of JP Morgan Private Bank writing, the stalling in the AI infrastructure trade is a healthy reset, underpinned by extraordinary earnings. We have revised up our mid-year target from 7,800 to 8,200. Abby joins us now for more. Abby, good morning. Good to see you.
Good morning. Good to see you.
Let's get into the difference between healthy and unhealthy.
Yeah.
What makes this healthy this morning?
We have to keep in mind the run up to this, right? Like, this was a really torrid, rebound from the lows in March, right? Which was a very, shallow pullback considering what was going on in the Middle East. But I mean, semiconductors were up 75% year to date and 95% since the low, right? So to have this pullback on Friday, is somewhat healthy. Again, also their performance is underpinned by really, really strong earnings growth, right? Even the Mag 7, technology grew 50% year over year in 1Q. That's the fastest growth rate since the global financial crisis. So just very, very strong.
Can things be too good? Peak earnings growth, those kind of things. Could things be too good?
I think obviously that's the question, right? I think that's what the market's trying to sniff out right now. What is the longevity of this, right? Especially when it comes to these memory chip companies, right? Which tend to be obviously very cyclical in nature and very short-lived, right? You usually have a 4-quarter cycle. And now the question becomes, okay, is this double that? Is this an 8-quarter thing now? That, I think, is the big question right now. And you're seeing partnerships and you're seeing a lot of change in the business structure of those companies to make the argument that that probably is the case.
If it's all about earnings, what's going to be the risk to getting to 8,200?
I think it's going to be the inflation and interest rate outlook, right? I think that's, really where you start to see pressure in the S&P 500 from a valuation perspective. Now, we did take our valuation target down. We had 22 to 22.5, and now we're at 21 times, which is basically flat from where we are today. So earnings is really driving all of that growth in terms of our target to 8,200. And I really think it's going to be the narrative around what happens from interest rates and what the Fed is going to do in terms of their outlook. We have them on hold for the year, so that's kind of,
But the market is pricing in now a hike.
Yes, right. And the market's kind of digesting it. I mean, not really. Obviously, last week was a bit of a momentum unwind, but for the most part, I think if you do, obviously, we have a very important inflation print this week. What happens with that and what happens with the volatility of interest rates is very important, too, because that's actually been rather subdued, even though you've seen interest rates move up the way that we have. The volatility of interest rates has been relatively benign, and that's why I think the market was able to digest it over the last month.
To your point about the memory stocks and some of those places that we think of as more commodity-like in the tech space and things that used to be tied much more to the consumer, I think there's a big question now about what does that mean? Yeah. Because normally when commodities are over-earning, nobody gives them credit for it because the assumption is that that's going to change. Mm-hmm. So then it becomes, where do we go from here? And have they become a different part of the tech stack than they were when you were banking on personal items for that memory cycle to happen?
Right. I think the big question for memory, not to get into the weeds of it, is are they becoming more foundry-like, right? Where they're making these bespoke things for this build out. And I think it really just argues I mean, it's an all hands on deck type of situation, whether it's power, energy, you know, the inputs that go into the infrastructure trade. And again, why that trade continues to work 3.5 years into this build out, right? Since we had the launch of these chatbots, I think is part of the question, right? Like, now we're reaching this new phase with agentic AI where you need the coordination between these agents, and that's really where the memory starts to come in. And this has all just come to fruition really over the last couple of months. So that's the big question.
Another big question we've been asking throughout the whole of this morning is whether this market can handle the amount of supply that's coming. The IPOs, the equity capital raising, not just at Alphabet, but reportedly maybe even coming from Meta in the next few weeks or so. Watch this space, we've got no idea. But Abby, from your perspective, can we stomach that?
We can stomach it. I want to acknowledge, though, that it is a step function change different from what we've experienced over the last several decades, right? Like, I can't imagine how many people have been on the show talking about how there's scarcity in terms of public equities and it's a declining...
Shrinkage.
It's a shrinkage, right? And that was overtaken by private markets. And this is a very, very different scenario than what we've experienced since, like, the 90s, for example. However, obviously, the float percentage that they're floating is very important. And you also have to think about just from the demand side, like, what's the demand side, right? Buybacks, supposed to be, you know, projected to be north of $1.5 trillion this year, right? That growth is slowing, but it's still a huge nominal amount. You have consumer demand, you have M&A, right? So there are all of these different things that make it digestible to a certain extent, but it is, again, different from a sentiment perspective.
Was Friday the dip? Is that it? Is it over?
It looks like it this morning, right? Even with these headlines around Iran. I think that's the thing, though. I think that's something to keep in mind that we've learned, you know, pretty much in size since COVID, is that these dips tend to be short-lived, particularly when you have earnings that are driving that.
We'll see if this one is. NASDAQ futures this morning up by 1.6%. Abby, good to see you.
Good to see you.
Thanks for being here. Abby Yoder there of JP Morgan Private Bank. Special thanks to Sarah Hunt of Alpine Saxon Wood. Sarah, thank you. Quote of the weekend. I think it was Sid Prabhu out on X. Remember all the fears that AI were coming for jobs and then jobs came for AI? Do you like that? I thought it was a fantastic quote over the weekend. A blowout payrolls report, taking a bite out of this equity market.
And some people are saying how it's actually cheaper to hire humans than to run these AI models. And potentially that's the environment we're in right now. A blowout jobs report. The inflation print this week is going to be so important.
CPI on Wednesday ahead of a massive, the biggest IPO we have ever seen. SpaceX on deck at the back end of the week, heading into the Federal Reserve meeting, Kevin Warsh's first meeting. Chair Warsh down in Washington, D.C., a week away. Coming up tomorrow, Jack Caffrey of JP Morgan, George Salavados of Deutsche Bank, David Seif of Nomura, Nisha Patel of Parametric. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.